President of CTPF Board of Trustees and Chair of this committee. This meeting is being held in person at our offices at 425 South Financial Place. The Investment Committee is a committee of the whole and includes all CTPF trustees. A quorum for the committee is 7 trustees on site. We do not have a quorum at this time, but we will go on with the agenda and our presentations and go from there. So a little bit of a change. So please note the following. Access instructions for remote attendance and instructions for in-person attendance have been posted on the fund's website. All participants, please wait to be recognized by the chair before speaking, and please limit discussion for each trustee to 3 minutes. Please note that for our staff and trustees to focus on the business of the meeting, we will not respond to messages from participants using the Zoom chat feature. Please forward questions to memberservices@ctpf.org. Again, memberservices@ctpf.org. We will be participating in the public participation. We will now move to public participation. Do we have any members for public participation? Yes, thank you.
Yes. Ms. Tina Padilla.
Okay, good morning, Tina. Okay, we got a quorum now? Okay. We got a quorum. Hey, baby, listen. Well, I don't have a bit.
Good morning. Can you hear me? Hello.
Yes, we can. Yes, we can, Tina.
Hi, everyone. Good morning to all the trustees and all the trustees, the executive director, and all the fiduciaries present at today's meeting. I really appreciate the service that you provide for our members, and I'm here to speak regarding my one question. I'll get to that one question in a second. On June 20th, I spoke again asking that we restore the CTPF Communications Committee. On June 21st, I received an email from the executive director stating why he feels that the communication committee is not needed. If you'd like, I will forward that email to all trustees. Why I'm here and why the pension advocacy group was established is we must work together to repeal Tier 2, and we need a space where all members, whether Tier 2 or Tier 1, can work together to fix the mistakes, not even fix. We need to repeal Tier 2 and repeal the mistakes of the past. So please, like I said when I was a trustee, and if it offended somebody, these were my words. I was hoping that you'd understand me, because this is how I feel. Stop serving us things that we did in order. Trust, integrity, and transparency come when there is education, engagement, empowerment, and mutual accountability. And that's what we're here to do, and help and work together. My one question is to the trustees, when will the communications committee be reinstated? Members need it. Thank you. Have a wonderful meeting. Goodbye.
Thank you. Thank you for your comments. Is there anyone else for public participation? All right, thank you.
I do have a question.
Okay.
Thank you. Because we're amending the agenda or we're changing, do we have a quorum now?
Oh, we have a quorum now, so that's what I'm going to do. The roll call is next.
Okay, thank you.
All right. Okay, so now we will have a roll call.
Trustee Barajas. Trustee Beza,
Present.
trustee Blackwell,
Present.
trustee Nelson, trustee Ochoa,
He is.
trustee Price Ward,
Present.
trustee Riley, trustee Rodriguez,
Present.
trustee Benson,
Present.
trustee Washington,
Present.
trustee Woods. Thank you. Trustee Ochoa,
Here. Okay. There we go. Thank you. One, two, three, four, five, six, okay, seven. So we do have a quorum now, so we can go through the agenda as printed. Okay, so now we will move on to number 3, vote to approve trustee remote attendance and full participation. Do we have anybody online? Okay.
Okay. Do we have any trustees?
Yeah.
Trustee Riley, trustee Price Ward, trustee Riley is waiting, is online.
Okay, great. So the Open Meetings Act allows for remote participation by trustees if a quorum is physically present, which we do have, and a member cannot physically attend due to personal illness, disability, employment, body business, family, and other emergencies or unexpected child care obligations. Trustee Riley will be participating remotely this morning. Trustee Riley, please confirm that you are attending due to one of the exceptions previously listed.
Trustee, I think trustee Riley is having maybe some audio issues right now. She is in attendance, I've been told.
Okay.
She can't speak even if she's
Could she
not,
remote?
even if she's online. Because Padilla
Give her
was
able to speak and she will.
Oh, okay. Oh, okay. We're going to promote her to panelist so she can speak and confirm.
Thank you.
Oh, she does not have audio at this point. We're just trying to see if we can. She's, okay, now
So if,
you can ask, she's promoted as a panelist.
okay.
Yeah, now I can
Trust-
speak.
Oh, excellent. Thank you. Thank you. I just need to state your one of the categories that you are able to participate remotely.
Thanks, Jackie. I guess we can call it personal illness. I passed out in my garage and fell and fractured 3 ribs. And
No. Oh, no.
I have staples in my head, so I'm recovering.
Oh, sorry to hear that.
I didn't
But
need
you
anything
sound-
else, did I, Jackie?
No. Nothing
And
else.
that's
Oh,
why.
I am so sorry to hear that. I'm just thankful that you sound good. You
I always
sound really good. God. All right,
So
so.
anyway, I'm here.
Yes, thank you. Thank you for, in spite of all of that, you are still here online, and we would definitely appreciate it. We have established a quorum, so we will take a vote on your full participation.
We need a
Thank you.
motion?
Yes, I need a motion. Yeah.
Yeah. Where's my phone? Oh, here it is.
roll call.
Yes, please.
Trustee Beza,
Thank you all for the motion, and we have the roll call vote now.
trustee Beza,
Yes.
trustee Blackwell,
Yes.
trustee Ochoa,
Yes.
trustee Price Ward,
Yes.
trustee Rodriguez,
Yes.
trustee Benson,
Yes.
and trustee Washington.
Yes.
Thank you, 7 ayes.
Thank you all. The motion passes, and trustee Riley will be a full participant in this meeting. And thank you again, trustee Riley, for your dedication and being here. That has got me shook and shaken a little bit. but I'm glad you're okay. Okay,
Thank
so
you.
now we will move on. You're welcome. We will move on to approval of the minutes. I will now entertain a motion and a second to approve the April 5th, 2024 Investment Committee minutes.
So move.
It has been moved and second. Please call the roll.
Trustee Beza,
Yes.
trustee Blackwell,
Yes.
trustee Ochoa,
Yes.
trustee Price Ward,
Yes.
trustee Riley,
Yes.
trustee Rodriguez,
No.
trustee Vincent,
Yes.
and trustee Washington.
Yes.
Thank you. 7 ayes, 7 ayes, 1 nay.
Okay, the motion passes. Then we have the motion, I need a motion to pass for the June 7th, 2024 Investment Committee, first Friday minutes.
So move. Second.
Roll call, we have a motion and we will have a roll call vote at this time.
Trustee Beza,
Yes.
trustee Blackwell,
Yes.
trustee Ochoa,
Yes.
trustee Price Ward,
Yes.
trustee Riley,
Yes.
trustee Rodriguez,
No.
trustee Vincent,
Yes.
and trustee Washington.
Yes.
Thank you. 7 ayes, 1 nay.
Okay, the motion passes. Now we will move to number 5, and that's First Friday presentations. Before we go there, can I?
I had a quick question, and it's just a question. Why did we not approve the April 5th minutes at the June, at a June meeting? Or why are we behind as far as April 5th? And then, well, June, I understand.
Because we meet every other month, first Friday, but they are here. They've been reviewed and they have been approved. So I would love to get to the presentations.
No, but I'm
So-
saying, no, I know we started late. We were waiting.
Okay.
Yes. But I'm saying the April 5th, when there was a meeting on June 7th, what, is there a
I
reason?
don't think we had a physical quorum, so you
Oh,
weren't
wasn't
able
a
to take
quorum.
action at that time.
Okay, all right. That's simple answer. Thank you.
Thank you. So we will start with the presentations, and now I will turn the meeting over to our investment team for the First Friday presentations. Thank you so much.
Thank you, Madam
John.
Chair. Good morning, trustees. So we're taking a little bit of a temporary departure from our usual practice of bringing in managers that are either prospective or not ones that we're doing business with. Today, we're actually conducting due diligence on our own managers. As you know, we have a pretty busy schedule on most board meetings and investment committee meetings. So we're going to, as a kind of standard practice going forward, take at least one of our First Friday meetings to conduct due diligence on incumbent managers. And so today we brought in 2 managers that are on watch and then 2 managers that are also managing growth-oriented mandates, given that the market has, in some sectors, growth has been the big contributing factor to the move in the markets. Collectively, these 4 managers manage almost $1 billion of our assets, so it's important that we hear from them today. We have provided some suggested questions for you to ask them. Our staff also has questions. But before I turn it over to James to bring in our first presenter, does anyone have any questions for me? Okay. So our first manager is Western Asset Management Company. They are a core plus fixed income manager. They are on watch recently due to a portfolio manager departure. They are managing $556 million for us and have done so since 2003. So I'd like James to bring in Western Asset, please. Thank you.
Good morning and welcome to First Friday.
Good morning. Yes. Good morning. With us today from left to right, we have Trustee Vincent, Trustee Washington, Executive Director Lenore, Trustee Blackwell, Trustee Price Ward, Trustee Ochoa, Trustee Beza, Trustee Rodriguez, and joining remotely, Trustee Riley. Our Chief Investment Officer, Fernando Vincent, our consultant from Callan, Tony Lasuzo, along with investment staff. You'll have 25 minutes to present, followed by 5 minutes for questions, and you may begin your presentation now.
Thank you, James. Good morning, everyone. Thank you for the opportunity to be here for your first Friday meeting. Very much appreciate that. My name is Charlie Colby. I lead the public fund and multi-employer channel for Western Asset. And I'm also the primary relationship manager for the Chicago teachers. I'm joined on the screen via Zoom by my colleague and portfolio manager for the strategy, Julian Skolnick. Julian sends his regrets. He's sorry he was not able to be here in person today. He had a client on site yesterday afternoon, and the logistics just didn't quite work. We're based in Pasadena, California, but I'm very happy to be here in person. We have a few goals for today and want to ensure that it's time well spent for the committee. Please feel free to interject with questions if you have any, and we'll certainly leave time for questions at the end. We certainly want to provide an update on the firm, the team. As Fernando mentioned, we are on watch for portfolio manager turnover. I will address that item. Also talk a little bit about themes we're discussing with clients, portfolio that we manage for you, and kind of the goals and objectives of that strategy and how we view it fitting into your asset allocation. And then Julian will discuss markets. Certainly fixed income markets and markets overall remain very interesting. You're going to hear from some of your equity managers following this, and you're certainly seeing a volatile day today and over the past few weeks in equity markets. And then we'll talk about portfolio performance, positioning, and certainly leave some time for questions. Quickly looking at page 6 of our presentation on Western Asset, we're a global fixed income asset manager. Fixed income is all that we do. We've been managing fixed income for over 53 years, and we are solely dedicated to this market. We have investment offices in 7 locations globally and headquartered in Pasadena, California. Interesting dynamic in the fixed income market over the last few years. I mean, certainly you've seen more volatility in this market than you maybe would expect, but also than you've experienced over recent periods, with 2022 being the worst year for the bond market in its history. With that said, some of that volatility does provide opportunity and certainly resets valuations. And there's yield in fixed income markets today that hasn't been present really since the financial crisis, with the Federal Reserve keeping rates very, very low. We think that that's certainly a theme that we're taking advantage of, and one that we're talking to clients about very frequently. Whether it's strategies like yours, a broad market, US focused core plus fund that does have the opportunity to take advantage of strategies outside of the Barclays aggregate, but also income-focused strategies, credit, whether that's here domestically in the US or globally. And I would say our public fund clients within our channel, we certainly have seen inflows as clients reallocate to fixed income to take advantage of the higher yields and valuations that are available. As you think about the CTPF Core Plus portfolio, a few key objectives and things that we keep top of mind as we're managing it. One is generating high amounts of current income. We want to provide income for you when it's available in the market. Currently, the portfolio yields 5.8% relative to the benchmark right around 5%. We want to have that carry. That's going to be a key driver of performance going forward. And when you look at fixed income historically, generally 80+% of the returns in fixed income are from that income component. The second would be diversification. You've seen over the last month, the S&P 500 is down 2.8%. And one positive trend in the bond market, counter to what was experienced in 2022, is that diversification is back. And so over that same time frame, you've seen the Barclays aggregate up 2.6% and our portfolio up over 2.8%. So you have that balance in the portfolio, and that is a key theme, a key component and reason for having this strategy within your asset allocation, is really providing that diversification. I will touch on personnel quickly. Page 14 in the presentation. This is our U.S. broad market team. This group of individuals manages all core and core plus strategies, as well as some shorter duration strategies for the firm. And, this is a very big business for Western Asset, over 120 billion in assets today out of the 380 total. This is kind of the core, the backbone of our business, and an area where we allocate a number of resources. You can see the portfolio managers listed on the left side of that page. Julian Skolnick, who is the lead portfolio manager for the CTPF Core Plus strategy, around just halfway down. This group is led by Mark Lindblom. Ken Leach, our co-CIO, is a key member of the team. And this is an area where we have very, very deep resources. And while we are on watch for a recent portfolio turnover, we did have a portfolio manager leave in May of this year, John Bellows. John was, we very much appreciate his contributions to the firm. John was a great communicator, a great kind of synthesizer of investment ideas. He was kind of on the front foot. You would see John in the media. Sometimes you would see him on CNBC. Certainly see him communicating to clients. But one key facet of our approach, it is a team-based approach. It's certainly not a star portfolio manager system. We expect all of our core plus strategies to kind of be positioned the same. These portfolio managers are not crafting portfolios and competing against the person who's sitting in the seat next to them. They're striving to position portfolios across the core plus suite consistently. All of our strategies should have the same themes kind of within the specific custom guardrails of that portfolio, but thematically the same, and all generated from a team-based approach. When you talk to Mark Lindblom, who leads our U.S. broad market team, he certainly says that he'll miss John, and there's no doubt that that is the case. But mostly from that client communication standpoint, he has a lot of confidence with the day-to-day portfolio management, blocking and tackling. And Julian has been your lead portfolio manager for a number of years. So a lot of continuity on that side. With that, those are kind of the key issues that I wanted to mark off, talk a little bit about the portfolio, the role that it plays in the overall asset allocation, the diversification and the diversification that it's providing today. And that's a welcome theme, as fixed income investors, really over the last few years, seeing the correlations, traditional correlations that you would expect between equity or risk assets and fixed income come back into play is something that we really welcome following the experience of 2022. And then briefly touch on the organization, personnel. Very happy to be here. Thank you for the opportunity. If I could, I would turn it over to Julian. He is joining remotely. He can talk about markets. Certainly markets remain interesting. The themes that are key for fixed income kind of in every market environment, the Fed, inflation and growth are certainly the operant factors really for all asset markets today. Everyone is very focused on these themes. These are themes that we're focused on really in all stages of the business cycle. And so I think he's very well positioned to speak to that. We can talk about performance both more recently and over the medium and long term, and a little bit on portfolio positioning and how that kind of interplays with our outlook, if that makes sense.
Yes.
All right, great. So Julian, I will turn it over to you. I would expect that he's going to start on page 17, but we'll see which direction we want to take it.
Okay, can you hear me okay?
Yeah, loud and clear.
Yes.
Okay, great. Well, thanks everyone. We really appreciate the time and appreciate the relationship. So I want to run through just at a high level the performance of the portfolio, how we're positioned. Happy to take any questions now or along the way with regards to the portfolio, and then we could spend a bit of time on the outlook and current market conditions given all the things that are going on as Charlie referenced. So page 17 is a good starting point. This has oh, sorry.
One second,
Yeah,
Julian.
thank you. Page 17, and what page is in our hard copy, because it's not the same.
It is on the soft copy, the page 17 is the outlook. In your hard copy, page 17, it's the performance.
Okay, thank you.
Okay.
Go ahead, Julian.
Okay. So with, the performance, again, a long relationship, which we appreciate, and over the long period of time, have been able to deliver the returns that we expect and that you expect. Clearly, Charlie referenced the challenges in 2022 from a market perspective, and we were not immune to those. We had our challenges, and we can talk about that if need be. But we are behind on the 3-year number, and so that's really where our focus is, trying to.
I'm sorry. I was confused because what's on the screen is not page 17. Thank you.
I understand. I think we're all good to
Okay.
continue.
Yeah, trying to work on that 3-year number. More recently, like we've seen it, the 3-month number on the far left there, and then more recently here to start the third quarter as well, we are seeing some good improvements in the markets and our positioning. So why don't we look at that positioning more closely on the following page? This shows the 3-month number as well as the 1-year number, and I think, again, well, the 1-year number, has been a bit frustrating, obviously, in terms of, generating excess returns. A couple things to highlight on this page. The first would be that, over the past year, what you tend to see is that your non-treasury sectors, so your quote risky assets, your corporate bonds, your securitized product bonds, things that are not treasuries, those returns have tended to be positive for the most part. There's a couple exceptions on here, but those are those green bars that you see above the line. And then the large negative is coming from the duration, so meaning risk-free treasury rates. And so what that means is this is, we would call this a negatively correlated assets. So while one group of asset classes is doing well, the other one's not doing as well. And when we build portfolios, we want to build in that negative correlation into portfolios, so not all positions are moving in the same direction at the same time. Now, we tend to view the spread product sectors, again, your non-risk-free assets, as the place where we can generate income, generate return, generate yield from. But we know that there will be periods when those assets underperform. And so we want to have an offset, or we want to have diversifiers to those credit positions. And we do think that over the long period of time, that treasuries, risk-free assets, do provide that diversification. That was obviously the challenge in 2022, where those correlations broke down and treasury yields were moving higher at the same time that corporate bond spread prices were going down. And so basically, essentially moving in the same direction. What we've seen now, though, in the current environment, where inflation is much more in line and making good progress towards the Fed's target, we do see that when risk assets underperform, treasuries can now provide that traditional role that they have had as a diversifier in the portfolio. Again, we're just seeing that certainly accelerate today. There was a payroll number released this morning, and sort of consistent with recent economic data that we've seen, those numbers would indicate a softening of the labor market, some reductions in the growth potential of the economy, and that tends to lead to lower treasury yields. And so having an overweight to treasury duration and treasury risk-free treasury exposure in the portfolio, that would be working as an offset to the credit position. So that's sort of just the first high-level comment on this page. The other point to note is that over the past year, our bias has been to move your portfolio and all of our portfolios up in quality and up in liquidity. And so why are we doing that? And what we see over the past year has really been the environment has been very good for a lot of these fixed income investments. And so that has led to higher prices, tighter spreads, in the credit markets. And at Western Asset, we are a value-based manager. And so we want to feel that there is sufficient upside in order for us to make an investment. So not only do we need to be constructive on the fundamentals of an individual company or sector that we're investing in, we also want to feel that there's the potential for some price appreciation. And so the higher those prices go, that tends us to lead us to be a bit more defensive and reduce those position sizes. And so again, over the past year, it's been less of a fundamental concern that we've had that the economy is really slowing and we're really going to have a significant challenge for growth, but it's more been that the prices continue to go up, and we've been reducing our positions as a result of that. So if you flip forward 2 pages in the soft copy, I think it's page 20, this shows you on the left-hand side of the page, this shows you the various sectors that we're invested in within the portfolio. The blue bars are our positioning. The red bars are the benchmark's positioning. And so a couple things to note on this page. You can see high yield credit kind of right there in the middle. These would be your below investment grade rated bonds. This position has come down and it's a bit less than that today. So we're closer to 2% today. So it's not a large out of benchmark allocation. Our bank loan allocation, which is also below investment grade, so high yield rated, this position's down by about half from where it was at its peak. Our emerging market exposure, you can see EM governments. These are dollar denominated government bonds of emerging market countries. These are now barely over the index, so close to the index level. We do still retain some locally denominated government bonds in emerging market countries. So that position, which has been quite volatile, has also been reduced. And the sectors that have grown in percentage over the past year would be your higher quality sectors like agency mortgages. These are mortgages with the implicit guarantee of Freddie Mac and Fannie Mae, explicit guarantee by Ginnie Mae. That allocation has grown, as has our allocation to non-agency commercial mortgages, non-agency residential mortgages, with the bulk of those purchases coming at the very top of the capital structure, AAA rated predominantly, and then our investment grade credit there in the middle. We've really continued to hold on to these positions. The spread levels aren't great, but we also think that the default risk is pretty low when it comes to the investment grade rated position. So again, it's been a shift up in quality, up in liquidity, and that's been driven primarily more by valuations. We have gotten the question, well, if valuations are as tight as they are, for example, within the investment grade credit market, we're through the long-term averages, why aren't you actively getting down further in terms of the risk in the portfolio? And our thought really has been that when we look at the overall fundamentals of the market, the growth potential of the market, inflation returning towards trend, and both of those factors, setting up, the high possibility that the Fed could be easing policy shortly, that's typically the environment where corporate credit tends to do well. And so there have been periods in recent past where we've seen corporate credit spreads remain at relatively tight levels for prolonged periods of time to the extent that these macroeconomic conditions persist. You saw that in the run-up to the GFC, you saw it in the mid-90s. So we do think there are, again, episodes where corporate credit can just sort of hang out at a maybe tighter than average spread level, but you are earning your carry, earning your income, and we think that's an important part of it's been an important part of the return profile over the past year, and we would also expect that to be an important contributor to the total returns going forward. On the right-hand side of the page, you can see this shows the duration of the portfolio, and then we break it out at various points along the yield curve. So where are we taking risk? Is it longer dated maturities? Is it shorter dated maturities? I think the big point to note here is that when you look at the long end, so out at the 20-year and the 30-year points on the curve, you put those together, and it's only a very modest overweight to long dated securities. And we've been reducing those positions and buying positions more at the 5-year point on the curve, the 2-year point on the curve. And the reason for that is As we move forward, there is a lot of uncertainty about the fiscal situation of the country. Depending on the politics and the outcome, there's going to be implications for taxes, for the regulatory environment, and all of that uncertainty we think has the potential to impact longer dated securities more so than shorter dated securities. And so we've been, again, moving the positions to the front end of the yield curve, as we term it. And we also think, given where we are in the cycle, how long this recovery has gone on for, and the fact that the Federal Reserve has not yet started to cut interest rates. They did give a indication at their meeting earlier this week that September would certainly be a reasonable expectation for when you could expect the first rate cut. We would also, be of that view, and I think that's generally the market consensus as well. But typically at this point in the cycle, when the Fed is gearing up or when they're just beginning to cut rates, you do tend to see the yield curve steepen, which means that shorter maturity yields fall more than longer maturity yields, and therefore we want to be positioned accordingly for that. So that's the yield curve positioning. And then the overall duration, which you can see at the bottom of the page, 653 versus 595 of the benchmark, means, again, we're slightly overweight duration, about 110% of the benchmark duration. We can be up as high as 120%. But we really, think that in this environment, today 10-year yields, 385. We were at 5% in the fall last year, so they have come a long way. We do think there is more room to go, but the pace of that decline, we still think it may be a bit more moderate than what the market's expecting at the moment. So we want to be positioned to be overweight relative to our benchmark, but not be at our maximum overweight position, and really reserving that for when we think there's a really significant opportunity in the market. But we do think that treasuries continue to be a good diversifier to spread product. And we also think that the fact that inflation is continuing to make progress towards the Fed's target means that longer dated yields do have room to fall.
So Julian, we're close to our 5-minute time.
Yeah.
Quickly, would you like to highlight some items from our outlook on page 26?
Yep, that would be perfect. A lot of these themes, I sort of hit on, but I would say that our base case does continue to be that inflation is coming down towards the Fed's target. It's taken a while. It has not been a smooth process. We saw, certainly a hiccup in the first quarter of this year. But since then, the data has continued to move in that direction. So we, say that's ongoing but uneven. And we think that the growth of the economy also is in a sustainable place today. So you think back to, really this time a year ago, we were getting GDP growth numbers in the 4 to 5% range. Those numbers to us we didn't think those were really sustainable. We thought that growth would revert to more trend-like levels, and low but positive, sort of in the 0 to 2% range. And that's what we've been getting more recently. So those numbers are more sustainable. The 5% numbers we do not think were sustainable. And typically, again, if you have this sort of low growth environment, inflation not problematic, that should allow the central bank to begin to ease policy. We think the Fed's set up to do that. And that's also true on a global basis. Recently, you've seen many developed market central banks cut rates because they're in a similar position. Bank of Canada, ECB cut again. The BOE cut for the first, Bank of England cut for the first time this week. And so we do think that is a trend that central banks have made substantial progress on the inflation front, and they now are in a position to ease policy. So that, again, should be an environment that's supportive for higher yielding sectors elsewhere. And that is how we are positioned. So happy to pause there and see if there's any questions, portfolios, positioning, or anything going on in the market, which there's been a lot happening recently.
Yeah, thanks, Julian. We're right on time, so certainly happy to take any questions.
Okay, I do have a question. You were talking about rate cuts and your predictions of that. So How many rate cuts do you anticipate, or your chief analyst, your chief economist have forecasted for this year?
Sure. Yeah. Just for context, at the beginning of the year, the market was, expecting 6 or 7 rate cuts for the year. And we thought that was, much too pessimistic. You got, better data in the first quarter, and those rate cuts all got, sort of priced out of the market, and the market, was actually pricing in, only 0 to 1 rate cuts. And we said, 6 or 7 was too many. 0 to 1's not enough. Our view has been that, 2 would be appropriate for the year. And over the past couple of months, as the data has continued to go in the direction that the Fed would like to see it going, you've seen that pricing come back to the market. Now, over the past couple of days, the market pricing is actually accelerated, and the market's now pricing in, close to 4 rate cuts for the balance of the year. We don't think that the economic fundamentals are that bad yet from what we've seen, but we would be skewed if 2 is sort of our base case. We would think that the Fed goes more rather than less than that. And so again, 2 is sort of the base case, but could they do 3, or could they have a 50 basis point rate cut as their first one if they felt like they really needed to? We do think that would be appropriate. So I'd say right now between 2 and 3 would be our expectation for the year.
Between 2 and 3.
Yeah.
Yes, Executive Director.
Yes, and thank you both for your presentations today. Julian, my question is related to the move to shorter durations. Is any of that predicated on your bet in terms of the election, or are these moves you would make regardless of what happens?
Yeah, so a couple points. One, I think just where we are in the cycle, the longer the cycle goes on, they don't go on forever, and so at some point there'll be lower growth, and so we do want to be positioned accordingly. The yield curve has remained relatively flat to inverted for a long period of time, and so again, the closer you get to the Fed beginning the rate cutting portion of their cycle, that does typically mean the curve steepens. So just from sort of where we are in the cycle, we would be of the view that the front end should do better. As it relates to the election, we think it does introduce an element of uncertainty, and we think that uncertainty impacts longer dated securities more than shorter dated securities, and specifically around the fiscal uncertainty. That again, concern about the fiscal outlook for the U.S. economy, how much supply would be necessary, how many treasuries would have to be issued in order to meet the fiscal demands. All that we think disproportionately affects the back end. So yes, the election uncertainty, does make us a bit more cautious on the long end, specifically.
Thank you.
Sure.
Yes. Just a quick question. I'm not sure if it would be directed to you or not. The diversity profile we just received, it was not in the packet we received last week. It was at our table site.
Yes.
Is this something you sent in, or is this something that the pension fund puts together?
This is something that we completed. Apologies, it wasn't in the deck initially. We did get the request last week. These numbers are as of December 2023, and we wanted to ensure that you had the most up-to-date information. But this is information that Western Asset completed reflecting the diversity profile of the firm.
Okay, just want to make sure. And you tally all this only once it's annual only?
We do it by request. So we certainly can provide it as of any date that you would specify.
But even when it's by request, you can provide it, what, is it quarterly or it's for
Quarterly, probably a month-end date would be appropriate, but we could provide something as of 6/30 or as we sit today in August. I'm sure we could update this through 7/31
No,
as
I
well.
guess what I'm trying to ask is what's the standard for it? Other firms other funds that you present to? Is it generally just sent out a year? It may be, I don't know. That's why I'm asking.
In general, for firms that require this data, typically once a year they would ask for it, but it could be aligned with the fiscal year and you could get it on a quarter end as well.
Okay, thank you.
On this front, and I guess one comment I would make, we understand the brokerage requirements that the plan has. I'm happy to report that we're in compliance with the brokerage requirements. over the past quarter and the past year for our minority, women-owned, and diverse brokerage trading.
Yeah, because I think that is from years ago, back in the middle 2000, that it was a requirement that we always ask it. I know the other managers already had in their packet. And the other thing, as far as your report, thank you for your report. I was going to ask, can we start getting something, and I've seen it in some of the other managers' reports, something, just a summary where everything is just on, one-page brief. Like, I'm not asking you to do any extra work, because I felt some of the information that you gave us was good, but we're kind of jumping from one topic to the other.
Yes, absolutely.
Sort of at a glance, so it's all consistent.
Yeah, we'd be happy to do that.
Thank you.
Any other questions? Yeah. Oh, okay.
Trustee Vincent.
Trustee Vincent and then Trustee Ochoa.
No, I'm just curious, there's like a prediction for Latin America to growth in Latin America. I'm wondering, what is that based on, and what markets or what countries?
Sure. Emerging markets, one, just I would say in general, before we invest in emerging markets, we tend to, emerging markets tend to be, pretty correlated to the global economy. And so if the globe is doing well, and, it's not just the US that's doing well, but, other countries are doing well, that tends to be supportive of EM. So that's the sort of just first comment. And then second, when we look at EM and we look at where there are opportunities to invest, we are skewed towards Latin America, as you point out. Currently, Mexico would be our biggest position. Brazil would be our second largest position. And then we do have some smaller positions in some Asian countries outside of China. A couple of reasons for that. One is, Chinese growth prospects, we think are not as, they haven't been as great as they have been in the past. We don't think they're bad, but we also, are, watching that. And we think from a political sort of standpoint, one of the lessons over the past couple of years was, just being cautious, and certainly from a corporate perspective, about having all of your, supply chains concentrated in a country that, one day could be an adversary potentially. And so all those, factors have sort of, led us to be a bit more cautious on China. And, post-COVID, what we've also seen is a lot of companies diversify supply chains outside of China. Mexico has been a big beneficiary of that, as have some other countries in Asia. But certainly Mexico has been a big beneficiary. So that's one positive for it. Mexico's proximity to the United States, and sort of, benefiting from the growth of the US, disproportionately, we think benefits Mexico versus some other countries. Mexico's central bank has run, pretty orthodox monetary policy, so their inflation rate has come way down and is close to the central bank's target. And despite some of the politics in Mexico, they have run pretty good fiscal policy, and therefore sort of contributing to the better inflation environment. So all those reasons, we felt it made good sense to have an allocation there. We also think from a valuation perspective, Mexican local government bond yields 9.5%, 10% kind of range. We think offer pretty good value versus what we can get in some other sectors of the market. And so that's led us there. But I would say, your point is right, that we are skewed towards Latin America. Russia, obviously no longer sort of an investable country. Much of the Middle East, lots of concerns about volatility there. And those countries do tend to trade at very tight spread levels, given the better, the very high credit ratings. And so in the current environment, we are more skewed towards LATAM.
Trustee Ochoa.
Hi, so thinking about why you're here on the watch list and just trying to get off of it and stay off of it.
Yeah.
And I think also what Trustee Rodriguez brought up, just being prepared or having a program where you have somebody on deck to fill in. You don't want change, but it's going to happen. But also addressing the diversity question, maybe you have an intern program or something you could brag about, or maybe you are looking at it to see how you're going to be able to bring more diversity into the company. Can you address that?
Yeah, absolutely. Thank you, Trustee Ochoa. I would say answering both the questions. So as far as succession planning, having folks that are on deck and ready to step in, we do have a very in-depth and succession planning process across all key positions across the firm. So really identifying talent, not just, one layer down or two layers down, but we try to strive for 3 or 4 layers down, someone who would be ready today, someone who would be ready in 2 to 4 years, and someone who would be ready in kind of the 4 to 6 year time frame. And that is a very thoughtful process that the firm goes through for all key roles. As far as John's specific departure, I think from a day-to-day perspective, from a portfolio management perspective, this is a very deep team of ours. But we are looking to backfill that role, not necessarily specifically with John's capabilities, very unique individual, but someone who's at the more in the midpoint of their career that can grow into that portfolio manager role. So that's the specifics on John. As far as diversity, what we try to do on that front, I think it's really it's 2 points. One, it's recruitment and it's retainment. We do have a number of employee resource groups focused on diverse areas of the market, whether it's our Latin American colleagues, our Black colleagues, our LGBTQ colleagues, all have specific ERGs. We do have an internship program. I think that does focus certainly on more diverse candidates, and we do have a specific recruitment effort with Black colleges ongoing currently. So it is a key focus for the firm. We think that there's benefits to having a kind of overall diverse profile and getting more diversity and having more diverse viewpoints in the room. So I think all of your questions and points are very well taken.
Okay. All right. Any more questions? Seeing no more questions, I would like to thank you, Charles and Julian, for coming in today. And if you had any final comment.
No, thank you very much for being here. We very much appreciate the longstanding partnership with the plan. It's a very important relationship of ours. We understand you're kind of undergoing bigger picture changes to the overall fixed income profile with your active core search and potentially switching that allocation between core and core plus. And anything that you need from us at Western, we're very happy to provide. So thank you for the time today. Thank you for the longstanding relationship, and I hope the rest of your meeting goes quite well.
Thank you very much.
Okay, so our next manager is William Blair. They're managing 2 strategies for us, both on international. The team presenting today will talk about their international small cap strategy. We placed that mandate on watch back in March 2023 for performance reasons. They're managing $186 million for us, and they've been on our platform since 2007. So it's a roughly 17-year relationship. So,
All right. Morning.
Morning.
Morning, and welcome to Chicago Teachers First Friday. With us today, from left to right, we have Trustee Vincent, Trustee Washington, Executive Director Lenore, Trustee Blackwell, Trustee Bryce Ward, Trustee Ochoa, Trustee Beza, Trustee Rodriguez, and joining remotely, Trustee Riley. Our Chief Investment Officer, Fernando Vincents, our consultant from Callan, Tony Lasuzo, along with investment staff. You'll have 25 minutes to present, followed by 5 minutes for questions, and you may begin your presentation now.
Well, good morning. Thank you for inviting us to be here this morning. It's been a while since we've been here, so thank you for the invitation. It's great to see everyone in person. So my name is James Dominguez. I'm your relationship manager at William Blair, and joining me today is DJ Nyman, who's a partner at the firm and co-portfolio manager on the international small cap growth strategy that we're here to talk about today. You've been invested in this strategy since 2007, so thank you for your trust in William Blair all these years and that longstanding partnership. Now, before DJ jumps into the strategy, let me just give you a quick recap as to who we are as an investment firm. William Blair is an investment management firm that is headquartered here in Chicago. We've been around since 1935. We started off as a small Midwest financial services firm that over time has grown into what we are now, which is a global boutique with clients and resources across the globe and investment expertise across several asset classes. We oversee about 72 billion in AUM, and that's solely focusing on active management in U.S. growth, core and value equities, as well as global equities, emerging market equities, and emerging market debt. A distinguishing characteristic of William Blair that we always like to point out is that we are 100% active employee owned. And that ownership structure is important because we feel it allows us to attract and retain talented investment professionals. And it also contributes to the stability and continuity of the firm that our clients value. Lastly, before I hand it over to DJ, I just want to say I've been your relationship manager for over 10 years. So I know the value that's placed upon diversity at Chicago Teachers Pension Fund. And one of the things that I want to share is that obviously at William Blair, we too value diversity of skills, experience, capabilities, and perspectives. We feel this is essential for deriving that innovative thinking that our clients demand from us. And with that, one of the things I wanted to share with you is something that I think is pretty unique. It's the Asset Management Diversity Accelerator Program that was put together by William Blair, Legal & General, and Allstate Investments. It's a 24-month rotational program where candidates spend 8 months at each of the 3 firms. And after 2 years, they have the opportunity to interview and apply for full-time positions at either of the 3 firms. This is a unique program because it specifically recruits from underrepresented groups. It helps contribute to that diversity in financial services. It helps contribute to diversity of thinking and background within investment teams. And the first cohort started last year. It's made up of 6 women, 5 of them from historically Black colleges and universities. So this is a program that we're very proud of. I hope that over time I'm able to share more with you. But again, this is something that I think it's pretty unique. We're very proud of it, and I just thought you'd appreciate hearing about it. So with that, I'll step back and I'll hand it over to DJ to jump into strategy.
Okay.
Good morning, everybody. Thank you for the time. It's very nice to be here with you today. My name is DJ Nyman. I'm a portfolio manager on our global equity team. I've worked at William Blair for about 20 years, 15 years on the global equity team as an analyst, as a co-director of research and a portfolio manager. So as James said, on behalf of all of us at William Blair in Chicago and around the world, thank you for the relationship, for being such a longstanding client. That's really incredible in 2 of our strategies. Thank you also for the opportunity to present to you here today. James and I are here to discuss our International Small Cap Growth Fund. It's about a $1.8 billion strategy, and your account is about 10% of that. So incredibly important to us. As James mentioned, William Blair was founded in Chicago in 1935. Its heritage is in financing and investing in small and mid-cap growth companies, originally in the US, but globally for several decades now. We are strong believers in the asset class, really kind of 4 reasons behind that. 1, that small cap companies grow faster than large ones. 2, that they're often backed by founders and shareholders that have skin in the game. 3, they're key beneficiaries of mergers and acquisitions. And 4, really, the market is inefficient. There are about 6,500 small cap companies outside of the United States that are not followed by the big investment banks on Wall Street. We have a talented team of first-rate investors that have very diverse backgrounds. I'll touch on that in a minute. And we employ a time-tested philosophy and a fundamentally based bottom-up process to identify companies and invest in companies that offer the superior corporate performance. So how do we define that? That is enduring growth and reinvestment at high rates of return. We believe those are the key ingredients to generating long-term investment returns for our clients. The investment backdrop for the last 2.5 years has been quite challenging. 3 key drivers of that being inflation, interest rates, and international conflict. And this has led to a severe repricing of the best international small cap companies. Quite frankly, the results that we have delivered for the Chicago teachers have not been good enough. We are absolutely focused on improving that. We believe in continuous improvement. We strive to learn from our mistakes, but we have not and will not change our stripes. We are and will remain quality growth investors. That being said, we think the environment is changing for the better as we speak. Two of the three variables that I just identified are improving. Inflationary pressures are easing, and interest rates around the globe either have begun to normalize or are anticipated to do so soon. While the geopolitical landscape remains complex, we believe the backdrop is transitioning, and the headwinds that we have faced over the recent past will transition as well. We think that the punishment that the best small cap companies around the world that have generated the most growth and returns on capital will perform again in the future. And we expect our investment performance to improve accordingly. So let's dig in. I'm going to touch on a few key pages of our team, our philosophy, then hit our results, our positioning, and touch on the outlook. As James said, we manage about $40 billion on our global equity team. I'm on page 12 of this. The two strategies that you are invested in are in the middle of page 12, our international growth strategy and our international small cap strategy. We manage this with one team, one integrated global platform, which is on page 16 of this deck. So we have 11 portfolio managers on our team, 17 analysts, 13 associates, about 70 people in total when you include our strategy team, our quant team. There's a lot of smiling faces on this page. I'll say in terms of diversity of thought and background and perspective is critical in investing in small cap international markets. About 1 in 4 of the people on this page speak a language other than English. I counted 14 different languages when I was going through it yesterday. And in terms of, from a geographic perspective, where these people hail from, we are principally located in Chicago and London. But there's a number of people obviously from the US, but beyond that, we have representatives from China, Argentina, Peru, Ukraine, Poland, India, and Russia in terms of our teammates, both portfolio managers and analysts. On page 17, it's just a quick recap of our investment philosophy, what we believe and how we manage money. And we believe an integrated investment platform directed towards identifying companies with strong corporate performance will drive superior investment returns over time. The companies drive the performance, not the portfolio managers. How do we define that? It really is sustainable value creation, which to us is enduring growth and reinvestment at high rates of return. How do we go about looking for that? We have a holistic perspective. We have all of those people on the prior page seeking and identifying companies that have strong competitive advantages around the world. We travel, about a third of our time is spent on the road. And we have systematic research and tools really integrating the art and science of investing. On page 18 shows the characteristics of your portfolio, the portfolio attributes. What does that look like in terms of the portfolio that we manage for you? It is a very high quality company or high quality portfolio. So you can see on the left-hand side of the page is your portfolio, the middle is your benchmark, and then the difference. So the returns on equity, the cash flow returns on invested capital are quite high, mid-20s%, quite a bit higher, 50% higher than the benchmark. We have much lower debt to equity, so less financial leverage in the companies that we have. And we're significantly higher growth. So on a historical basis, this portfolio has generated about 20% earnings growth relative to about 16%, 17% for the benchmark. The operating momentum of our portfolio is strong in terms of the breadth of revisions. So companies that are doing better, that are having positive revisions to their earnings forecast. And the valuation that we're paying for that portfolio today is about 20 times forward earnings. Just for context, that's less than half that it was in 2022. I'm going to turn to page 20 for a second and just try to lay the landscape in terms of we've got a map of the world and what's happening around the world that I think can then help us discuss performance in the portfolio, and then we'll get into our outlook and our positioning. So on page 20, we have some high-level points. These are supported by the following 2 pages, which are all the details in terms of the individual performance for these markets. But at a high level, what are we seeing? We're seeing, I'm going to start in Europe. European central banks have begun to cut interest rates. The ECB, the Swiss, Sweden cut during the quarter. The UK just cut interest rates this week. There is political uncertainty in both France and the UK as over elections. France has avoided a far right takeover, but political gridlock is likely to persist for some time. The UK, the Labour Party dominated in elections, and they're focused on improving the domestic market, the availability of housing, the improvement in healthcare, and other domestic infrastructure-related policies. Japan is quite an interesting market. It is improving in terms of the macro inputs into Japan, and there are structural reforms that have given life to Japanese stocks. The Japanese yen hit a 30-year low when we printed this book, and the weak yen was leading to higher inflation and a delay in real wages from turning positive. The Bank of Japan just raised interest rates yesterday, and the yen has strengthened about 8% this month alone. It remains down 6% for the year. And as a result of all these variables, exporters have significantly outperformed domestic-focused smaller cap companies that we invested, but we think that's likely to reverse going forward. In terms of China, there's evidence of that a cyclical backdrop in China has at least stopped deteriorating, and there's potential that we're entering in early stages of recovery with several indicators moving into expansionary territory. But the long-term prospects remain challenged, and we see moderating growth and rising overcapacity, in particular thinking about the property market. Taiwan and Korea have been they're tech heavy. They've benefited from the surge in semiconductors and hardware demand. And Taiwan has been the best performing country, and that's led by large cap semiconductors. India is benefiting from strong economic growth. It's relatively neutral in terms of geopolitics, and it's really benefited because of the investor unfriendliness of China. It's kind of in the sweet spot in terms of growth in their middle class and a favorable CapEx cycle. All of this is being reflected with higher valuations relative to emerging markets. Latin America was the best performing part of the market last year. It has underperformed this year. The recent election in Mexico has created some uncertainty around judicial reform and the fiscal side of the equation. So pages 21 and pages 22 are the background for those comments. I won't go into detail in here, but I will point you to the middle of this page that just shows small cap performance relative to large cap performance. This year, small caps have delivered about 2% positive returns relative to large caps at 13%. The market has been narrow, to say the least, if you think about certainly in the United States in the Mag 7, but that has also been the case in places like Taiwan with TSMC. IT has been the big performer down at the bottom of the page, up 24% on a year-to-date basis. The following page just drills into that to show what's happening in small cap markets. And small cap markets are different. We've seen significantly less performance, significantly worse performance in IT relative to large cap. So small cap IT is up 4% year to date. Again, that was relative to 24% for large cap. We have seen strong performance in places like India. So 20% growth or appreciation in the market in India versus 17.5% for large cap. But it's been a challenging backdrop for small cap investing. Turning to page 24, this is investment performance for your strategy. And as I said before, it hasn't been good enough. The top of the page shows what our annualized returns look like over time, and the middle and the bottom of the page show that by year. The couple things that I'd like to point out on this page is 2022 really being the driver of the recent underperformance. It was the first quarter and second quarter of 2022 as the interest rate backdrop, the inflation backdrop and interest rate backdrop, and an invasion of Ukraine by Russia that really hurt this portfolio and has led to underperformance over that period of time. You can see that in 2019, we delivered strong performance, 2020 the same, 2021 we held our own. 2023, we ended up eking out strong performance on balance for the entire year, up to 188 basis points for the full year, but all of that came in the fourth quarter. All of that came when interest rates and expectations for interest rates declined in the fourth quarter. So I think that helps frame how we're thinking about the forward-looking dynamic. I've got a page in here that shows our interest rate sensitivity and how we're thinking about that in terms of the portfolio. I'm going to touch on year-to-date performance for a second, and then I'll hit a couple of pages to support what I said there. And we can maybe leave some of the details for Q&A if interested. On a year-to-date basis, the biggest challenge, I'm looking at page 26 in the deck. The biggest challenge in the portfolio has been Japan. Japan is operating on a monetary policy cycle that is very different from the rest of the world. The Japanese central bank just raised interest rates this week. They finally ended, 3 decades of deflation. You are starting to see a bit of inflation. Wage negotiations that ended in April called for 5% increase in wages in Japan. That's the highest in 30 years. So Japan is on a different cycle than the rest of the world. It has been a value-driven market over the past really year and a half. That has led to challenging performance. You can see on the left-hand side of the page, this shows our relative performance by region. On the right-hand side, by sector. The right-hand side, you can see of the 5 top detractors in the portfolio, 4 of them have been in Japan. These are companies that are structurally advantaged in terms of their quality growth, companies that have delivered strong growth and returns, but the market has been focused on low quality, low valuation companies. Part of that has been driven by an effort by the Japanese government to improve corporate governance. They're focused on companies that trade at less than 1 times price to book, which means they generate low returns. So again, not our area of focus. I'm going to skip over page 27, but it does give you a little bit of context relative to our long-term performance. And really, as I said, Q1 and Q2 of 2022 being where this portfolio suffered the most. Page 28 just shows our interest rate sensitivity since that period of time. The US Fed is, like it or not, the central banker to the world. And so US interest rate policy does influence currency and interest rates in all the markets that we invest in. Page 29 just shows that impact in terms of the Japanese yen, which again, it's changing as we speak. But up until when this book was printed, the Japanese yen was at a 30-year low in terms of the currency. That's on the left-hand side of the page. And really what was driving that was the fact that interest rates were near 0 in Japan and they were quite high in the US. Small cap companies that we invest in Japan are principally domestic oriented, so the yen is really important to them. They're not the big exporters that benefit from a weak yen. In terms of positioning, I'm going to turn to page 33. This is a very broad portfolio in terms of where we invest, but you can see a lot of themes in terms of the type of companies that we're invested that are represented in the aggregate statistics here. So again, we're bottom-up fundamental investors. We focus on finding the best 100 companies outside of the United States in terms of investing in. And what that looks like when you aggregate it all up is on page 33. We are overweight Europe. You can see that in the middle on the left-hand side, 29% versus 23%. We have a very strong focus on the Nordics, where we see the quality of companies is significantly high. We're overweight the UK and Canada. We are underweight Asia, ex-Japan a little bit, but we are overweight in Australia. We've found an incredible few companies in Australia that are penetrating the US market and are growing quite nicely. We have about 1.3% in China. That's below the benchmark. The benchmark is about 2.5%, but we do have 26% in total in emerging markets, which is about even in relative to the benchmark. From a sector perspective, we're structurally overweight industrials and tech. You can see that on the right-hand side of the page here. We are, I'd say, cyclically overweight financials given interest rate dynamics, but that is a bit more tactical in nature. We are currently underweight healthcare, but I would anticipate that that would change as we see interest rate policy globally normalize. I'll stop on page 35. It's just a comment on the outlook, and then we'll hopefully open up for questions. In terms of growth, we are seeing, in the market as we speak, disinflation continuing to be a key driver. We think that that will help real income growth. We think that will support consumption growth, although we are watching what is happening and we are quite sensitive to changes in the marketplace that we're seeing right now. In aggregate, we think there will be slower, more normalized, but still healthy growth in terms of the backdrop. In the US, we see that meaning the GDP slowing down to around 1.5% to 2%. We think China is likely to remain challenged from a growth perspective. In Japan, we think that those real wages that we talked about, the negotiations, will lead to a better environment for consumption. All in all, we think interest rates will continue to normalize around the globe. Expectations for the US Fed to cut rates between now and the end of the year have certainly increased over the last 24, 48 hours. We saw the Bank of England cut interest rates by 25% yesterday. We see corporate earnings slowing, but the the selectivity of that growth, I think, will benefit this portfolio. Again, what we're trying to find is the highest growth, highest returning companies globally. And so the narrowing of that, I think, will be positive in terms of a quality growth focus within this portfolio. In the aggregate, we see modest but sustainable growth and entering an era that more closely resembles the era before the global financial crisis in terms of the environment. So there's a bunch more in the deck, but I'll leave that for either questions or for your reference. But I'm happy to stop and see if there are any questions that we can answer.
Mhm. You have any question?
If no one's going to ask a question, you all looked at me, so, okay.
Please.
I will say this, okay, your presentation is 53 pages long and you gave a lot of information, but the most valuable page of this entire report is your page 3. Your portfolio summary at a glance, and I wish every money manager would do that. Really, it is outstanding. Because just looking at this, I can see we're talking about performance. We're going back from the time of inception. So on that one, I do have a question, which says initial funding amount. Why was it an odd figure, not rounded off to $93,807,792? Why not 94, 95? On the left-hand side, it says summary and then millions.
You know, that's a
2,
great
3,
question.
4, fifth box.
That's a great question, but that was out of our control. That was funding from the Chicago Teachers Pension Funds. I wish it was 94, 95.
Yeah,
But it
well,
was 93.
but regardless, I'm just wondering why it was that, what calculation did you use to arrive? That's what I'm trying to figure out.
That is.
Who knows? Maybe it was supposed to be even less. I don't know.
Yeah,
but
that was the amount.
Then
of
I
the
would be
assets.
really happy.
Well, that was the amount of the assets that came in at that time.
Okay, that was one. Then I'm looking at your fees, which is CTPF management fees, second to the last box on this page 3. Total management fees before 2023. So right now in 2024, we're about halfway meeting that mark. We're almost there.
Correct.
Why were they so high in 2023? That was still, well, no, that was after COVID, correct?
Correct. Yes. And the fees are all dependent on asset levels. So yes, you're right. The 2024 fees are those laid out there. But yes, that was the correct fee at 2023 based on the asset levels at the time.
Asset levels, okay. And let me see. I'll let somebody else question. I'll keep looking.
Any other questions? Yes,
About your
President.
diversity, I'm sorry,
okay.
diversity program.
Yes, sir.
How do you
Can't hear you.
select the
I'm
students? I'm sorry,
I couldn't hear you. I'm sorry.
for the diversity program that James talked about, how do you select the students and what schools are you going to looking at?
Yeah, you know, that's a great question. Our HR department is the one that works with the variety of schools they target to recruit students. I don't know of the schools off the top of my head, where the 6 individuals came from. But I could certainly follow up with you and give you that information. And in terms of their process for recruitment as well. I don't know the specifics, unfortunately, of that. Yeah.
Yeah, I was involved in that. I guess just one thing I'd add, so there's 3 different asset management firms that are doing the recruiting. So it was a joint effort and we all did the interviewing together. And then there was a reconciliation among the different asset managers to say, okay, this is the person that we should choose. So, quite holistic in terms of that decision-making process and a great experience for them to, in particular, the 2 women that we had on our team last year, one was in technology and one was in consumer. And then they're in the same sectors, but in different asset classes at the other asset management shop. So an incredible experience for them to see kind of the entire cap spectrum and both equities and fixed income.
Is that number 6 on this? Is that what that is?
I'm sorry.
Was that question number 6 on the sheet?
No, I didn't have a question.
I'm sorry. Yes, go ahead.
So your changes that you're going to make to get off our watch list, can you anticipate when you would be able to turn things around, implement things and when those would have an effect so that you would be meeting or going over the benchmark?
Yeah. Well, so I guess a couple of things. what I would start by saying is from a bottom-up fundamental research process, we're not going to change. I mean, what we are, we have a high degree of confidence that it's the way to deliver investment returns over time. And it's focusing on, again, companies that can deliver either the magnitude or the duration of that growth is better than expected by the market. And it's a relatively inefficient market on that front. And so the focus from a bottom-up perspective will remain the same. I think what I'm trying to convey is that the market backdrop has been really complicated. And what we see, and in particular, the first two quarters of 2022, which I'll just be honest, like we got it wrong. So we were in the end of 2021, we were in the transitory inflation camp, and we thought that the Fed was going to be able to navigate through the environment, and that changed pretty abruptly in January of 2022, and that's where the biggest underperformance came. Was really the first quarter. It wasn't as bad in the second quarter. What we've tried to do is we've tried to adapt the kind of aggregate sensitivity in the portfolio to higher interest rates without changing what we do, because we're quality growth managers. So for us to start to look for low quality value companies, it's not our expertise. So the environment that we see, and that's why I put this page in here and to show kind of the interest rate sensitivity on I think it was bear with me one quick second, on page 28. And this is what this is our relative performance, and we've got the inverse of the US 10-year. So as interest rates have increased, our relative performance has suffered. And so we think as the backdrop, and really what we're talking about is the discount rate at which we're thinking about from a valuation perspective, growth companies that have a lot of growth in the future, that discount rate, if that is going to be decreasing, we think that will provide valuation support. So really, for the portfolio to perform, I think a neutral interest rate backdrop is critical. So the earnings growth that has been realized by the companies is about 20%. So the companies are doing their job. It's how the market values that growth, and that has been challenged over the past 2 years. We think we're moving into an environment where that will move from being a headwind to maybe not a tailwind, but at least not a headwind. And if it's not a headwind, we can still get that earnings growth that we seek. Again, on a forward-looking basis, it's about 17% earnings growth. So if we have returns driven more by earnings without kind of the negative implications of valuations coming down, we think we can deliver performance that you would expect.
So if I interpret what you just said, so you're changing very little. You're waiting for the market basically to readjust. Your part of our portfolio is doing what it's supposed to do, and as things change around it, it'll come up.
We're not happy with how we're performing. So we're always trying to get better, and we're always trying to learn from our mistakes. The market gives us opportunities to learn every single day. So there's plenty of room for improvement in terms of how we do what we do, but we're going to remain bottom up, quality growth focused at investors. And so the bottom up process is remaining the same. We're trying to make fewer mistakes, but still taking appropriate risk and consideration of that risk reward trade-off. But as the market environment becomes less of a headwind, we think that process will deliver. Again, so the point I was trying to make is that the performance has been driven more by valuations coming down, multiple compression, than it has been underperformance in terms of earnings growth. And in a high rate environment, the discount rate you use to think about the valuation of your companies, it's gonna hurt companies that have more earnings growth farther in the future. That's small cap growth investing. We're looking for companies that are small, that have an innovative product or service that can take market share, can grow. And in a high interest rate environment, it's difficult from a valuation perspective. As we see interest rates normalize, we think the market will return to focused on companies that can actually deliver the growth that we think our companies can do in aggregate in this portfolio.
Okay, thank you.
Yes, Executive Director.
Yeah, thank you, James. Thank you, DJ, for your presentation. I'll just follow up on Trustee Ochoa's question. If the issue has been lower valuations, when you said we got it wrong, what did you get wrong?
Yes. So what did we get wrong? We got wrong the interest rate backdrop. So as interest rates were increasing, the value of the companies in our portfolios were decreasing. And so we failed to anticipate, the Fed in the end of 2021 was talking about transitory inflation. We had all the stimulus that came after COVID, and we failed to anticipate the degree that which the Fed was going to increase interest rates, both the magnitude and the duration of that increase in interest rates. And so once that happened, we've tried to navigate through that while staying true to how we invest in terms of being quality growth investors. And so what we're seeing now is anticipation of the Fed cutting interest rates, so that becoming less of a headwind, and the quality of the companies so the growth rate of the companies that we have in the portfolio hasn't changed much. So it's really just how the market values them. And so what we anticipate is, even if we don't get a significant decline in interest rates, if it just stops becoming a headwind, then the growth that our companies generate, that can drive performance. Again, in the high teens in terms of growth that is anticipated for that. If we get a further decline in interest rates, you might get kind of the double whammy of strong growth within our companies plus valuation expansion, but we'll see. There's a lot of interesting variables in the market right now. I'm confident in the earnings growth. That again, and our job as bottom-up fundamental investors is really forecasting that, finding great companies, forecasting earnings growth, forecasting where we've seen returns that are improving in terms of the returns on capital. And the market backdrop, the interest rate backdrop kind of ebbs and flows, but it's been such a one-way kind of move against us, and we see that ending now.
Okay. All right. So you picked the right companies. It's just the market just didn't favor them at the
Look,
time.
there's 112 companies in this portfolio, so we're not getting them all right. Again, we make mistakes. Shenanigans happen in places in the world, India and Brazil and things like that. But on balance, yes, we pick the right companies. We can forecast their earnings growth, their financial performance, and it's really how the market values them on a short-term basis, which is a variable that's hard to predict. It's kind of outside of our control. So we view our job as finding the best companies, identifying them, sticking with them, and we think over time, over the long term, that will deliver superior investment returns.
Thank you.
Are there any other questions? Yes, go ahead.
So I'm just looking at, the countries that you're invested in, looking at other emerging markets that we may have focused on here.
Yeah.
I don't see any investments in Africa. Why?
That's in this portfolio, there's not. So we were recently invested in South Africa. We got a bit nervous about the political situation in South Africa going into the election. Over half the world's population is going to the ballots this year. I think there are elections in 54 different countries. And the South African election was complicated. So we owned a kind of like a CVS of South Africa, a company called Clicks in the portfolio, but we exited it prior to the election. I'll tell you, the emerging market strategies that we have on our platform, I'm a co-portfolio manager for an emerging market small cap strategy. They have moved back into South Africa in a more significant way. And they, in part because you've seen compromise, you've seen a coalition generate in that market. This strategy, we've got a much broader opportunity set. So when I think about the pluses and minuses of South Africa, I'm going to wait to see how it kind of works out a little bit. There's a little bit of euphoria. Again, a lot of unexpected outcomes in elections, even in terms of, even if you think about Mexico, the strength of the win by this current party, it was unexpected. So navigating through, again, like I tried to say up front, some of the geopolitical dynamics are complex. And so that remains an area where we're trying to navigate. But South Africa is largely the main investment location within Africa across our platform.
Thank you. Yes. No, I'm seeing no other questions yet. No other questions. Thank you. Thank you so much.
All right.
Good
Thank
to
you very
see
much for
you.
having us. Really
Good to
appreciate
see
your
you.
time this morning. Thank you.
Yes.
Thank you.
James, you're looking younger and younger.
Thank you for that.
Yeah.
All right. See you, everybody.
All right. Bye-bye.
Thank you.
Thank you.
Okay, so Zevenbergen is our next presenter. They're an all-cap domestic equity growth manager with about 105 million of our assets. This relationship is one of our older relationships, which goes back to 1992. It's also a female-owned and led company. But actually, before we bring in the presenter, Kelly was going to address the your question, Trustee Rodriguez, about the funding. She might have some insight into. I think maybe what happened was we may have targeted 94 million, and then by the time the assets move over, the stocks may have moved up and down, and that led to a lower amount. It's the actual market value of the stocks.
Okay,
So-
thank you.
Jackie? Oops.
Oh, God.
Yes. Yes, you have your hand up?
Yeah, I do. This is one
Okay,
of the
go.
first 5 minority investment firms we had. They're the only one remaining.
Yes, I'm aware of that. I was talking to Fernando about that. I think there were 5 before. And
Yeah, there were
now we're
5
down to
originally, and
5
the
original,
allocation
and
was
we're
60
down to
million
what?
for all 5.
Yeah. Thank you. Thank you. You know what? You provide wonderful historical information. It is so appreciated.
Thank you.
Okay, good morning, Zevenbergen, and welcome to Chicago Teachers First Friday. With us today, from left to right, we have Trustee Vincent, Trustee Washington, Executive Director Lenore, Trustee Blackwell, Trustee Price Ward, Trustee Ochoa, Trustee Beza, Trustee Rodriguez, and joining remotely, Trustee Riley, our Chief Investment Officer, Fernando Vincents, our consultant from Callan, Tony Lisuzo, along with investment staff. You'll have 25 minutes to present, followed by 5 minutes for questions, and you may begin your presentation now.
Thank you very much. Good morning, everyone.
Good morning.
Thank you for having us in today. We appreciate the opportunity to get to speak to you. My name is Tom Dixon. I am one of the newer individuals to Zevenbergen and just started at the beginning of the year. So I'm here to, as a new employee, thanking you for 32 years of relationship that the firm has had with you, and have been able to glean a lot of information from everyone, my colleagues that have been here for many years. With me today is Danny Blanchard. Danny's a research analyst in our investment team. Danny will be celebrating her 10th anniversary on Sunday with Zevenbergen. So we decided when we were coming in that even though usually I would give the introduction and talk a little bit about the history of the firm for everyone, that since Danny's on our 10 years and I'm on my 7 months, it probably makes more sense for her to talk to you and go through and give a little bit of history from someone that's been sitting in it for quite some time. So again, we thank you for everything. We have some prepared statements. Then we're more than happy to answer any questions.
So again, hear me all right? Thank you, everyone. I know he probably won't like the joke, but I do have a decade on Tom in terms of my relationship with Zevenbergen. I know everyone at the firm wants to, again, reiterate their gratitude for the invitation here today and the longstanding partnership since 1992. Now, we've been partners for a long time, but I know some of you might be new to the ZCI story, and I think it's one that's relevant and exciting and interesting, and we want to spend a lot of time on our process and philosophy today. So founded in 1987, Zevenbergen Capital is a majority woman-owned firm managing portfolios of growth-oriented equities for clients with long-term investment objectives like yourselves. In terms of ownership, our founder and chief investment officer, Nancy Zevenbergen, remains the majority owner with a 65% ownership of the firm. Our external partners, Virtus, have about a 30% share. And then in 2023, Nancy took the opportunity to distribute a small portion of her equity to a few key employees at the firm. So that would be Anthony Zachary, that I believe you've spoken to in the past, and Joe Dennison, who are Nancy's fellow portfolio managers. So we have 3 portfolio managers at the firm. And then as well to our CFO, Alexa Kopicki. So the 4 individuals make up our executive team, representing a 75% either gender or racially diverse executive team. I myself am on the investment team as well with Joe, Anthony, and Nancy as a research analyst, and have another colleague as well as an analyst. And I think something unique to us is, the 5 of us come into work every single day and we sit at one long desk all together, and we are talking about stocks and the market all day, every day, from the second we get in until the second we leave. So it is a very collaborative, team-based, analyst-driven approach, and we think that's really integral to our culture. Today, we manage about 4.7 billion in assets in total, with a majority of that dedicated to that core growth equity strategy that you are all invested in. So following an initial funding, like I mentioned, in 1992 from the pension of around $12 million, as well as a couple of smaller subsequent fundings of another 12 million. We are proud to have distributed over 265 million in assets back to the pension and manage about 100 million in assets today for you all. So maybe a smaller portion of the pension, but we think we can bring a nice, unique growth flavor and a little bit of spice, as we like to call it. So simply put, our mission is to build client wealth through concentrated portfolios of companies who are shaping the future, led by innovative and visionary management teams. Our investment process is very much an expression of that philosophy, which states that revenue, earnings, and free cash flow growth contribute the most to capital appreciation over long periods of time. So those elements we consider fundamental elements of the business, and we view those as more important to us than trying to predict macroeconomic moves or the headlines that may hit us every single day. So top and bottom line growth, like I mentioned, are the key drivers of long-term equity returns. And then strong management teams and strong financial positions, so strong balance sheets, really help companies protect their competitive advantage and give them opportunity to invest in the future as well. So I'm starting kind of on page 5, if you'd like to follow along with me in the, yes, the confidential and the public. So we found that the market often underprices growth businesses on either the degree or the duration of growth on a long-term basis. We found excess return opportunities in industries undergoing significant change. So often the most disruptive companies are, willing to challenge the status quo. And our analysts and our portfolio managers, we're trying to take advantage of the failure to imagine. So we're trying to see where estimates may be too conservative and really challenging ourselves to ask, rather than what could go wrong, which is an element of portfolio management, what could go right? I think it's really hard in an environment like today's to be optimistic, but to be a growth investor, you have to maintain optimism. I like to believe that, in order for us to grow as a society, our businesses, we will continue to innovate. It may be lumpy along the road, but businesses and society will be looking towards the next great companies to build the future. So I touched on our ownership structure, which is maybe the next page. Page 7, I think, really focuses again on that core thesis that fundamentals drive those long-term stock returns. And when we talk about, being an optimist, I think it's easy to think, well, who are some of the great optimists of the world and in the business community? It's often founders. So those innovators and disruptors willing to challenge the status quo, like I mentioned, sometimes in creating entirely new industries when other people call them crazy, quite frankly. We like to say that we sometimes have the novel opinion that people really matter, especially in the context of growth businesses. Some of the most successful companies, Amazon, Facebook, Netflix, NVIDIA, Tesla, what do they all have in common? They either are today or have been historically run by their founders. And a lot of those founders are either still the CEOs today, are chairpersons of the board, but they're still very much involved. It's an often underappreciated factor in stock research. Something you can't necessarily fit into a spreadsheet is the management team. And we spend a lot of our time focusing on that. And there's kind of 3 reasons for that. One, founders tend to take a long-term mindset. So as growth equity investors, we want to own companies for a long time period. We're not trying to just make a quick dollar in the next quarter or the next year. Our goal really is to hold these companies in perpetuity if they continue to innovate and they continue to grow. And investors tend to run their business with that similar mindset as well. So it's easy to get caught up in kind of the 90-day increments of portfolio performance, but founders tend to think in terms of years and decades, and we think that is most closely aligned with shareholder returns. Another very important factor is founders tend to have skin in the game, so they tend to be invested a long time alongside their shareholders in the form of equity compensation. So we pay very close attention to how much of their CEO compensation is linked to equity, how much of that equity is linked to performance. We find that is definitely beneficial over the long term. And a third, I would just say, they have soul in the game as well. This is an emotional investment for a lot of these founders. There's also been studies, out of Purdue, other universities, that founders tend to invest more in R&D. They tend to result in more patents. They tend to be very innovative. They attract unique workforces. I think they tend to be the most inspiring kinds of leaders. And we think that all contributes to long-term success of the business. So about 75% of the Zevenbergen growth portfolio is invested in founder-led companies today. It's not necessarily a prerequisite, but we do want to partner with management teams who share that long-term horizon. And speaking of time horizon, I'll say it again, revenue growth is really our North Star. So if you flip to page 10 in the confidential, I believe it's 8, maybe something different in the public, but 10 in the confidential. Speaking of time horizon, like I said, there are various elements of growth, and not all growth happens on day one of a company's mission. So we really like to view it across this business life cycle. So you have the beginning of the business life cycle really starts with that emerging phase in public markets. These are companies like Shopify, which helps small businesses create their own e-commerce stores if they want to be outside of the Amazon environment. A company like Toast that you may interact with when you're at a restaurant, either through the point of sale system, they're oftentimes the technology that's helping run the entire restaurant behind the scenes. These are companies that I've identified a problem, developed a product or a service to fix that problem, but may also be investing heavily to capture market share. So they tend to have very high growth rates on the top line, but maybe investing more on the bottom line. The next phase is kind of this high growth phase. So still companies growing revenues very fast, but can be as diverse as, public safety company Axon or affordable cosmetics company e.l.f. Beauty that some of you may be familiar with. Like I said, reporting high rates of growth, but also improving margins and profitability along the way. Then maturity, this is kind of more the established growth end of the spectrum. Companies that are more household names, think Amazon, Meta, kind of your largest capitalization companies. They've got established competitive positions. They're kind of considered the cash cows. So they might be able to have the most flexibility in times of distress or invest in other businesses as well. That red area of the graph, we do try to avoid companies in decline. That can be a challenge to predict exactly when that happens, but for obvious reasons, we're again looking for growth companies. So when we talk about growth, we're looking for durable revenue growth above 15%, typically for the next 3 to 5 or even longer periods of time. We know that all business cycles don't necessarily end at the same time, however. So we do see several instances over the years where, an established player either reinvents themselves or kind of bucks the trend of decline and inflects to the upside with new product introductions or lines of business. And we want to stay open to those opportunities as well. This is kind of the area where we may have more cyclical exposure as well. I think a great example of this would be semiconductor companies like NVIDIA, who has become a household name today, given the rise in AI, but they've been working on AI chips for many years, going back as far as 6 years ago. So that's kind of how we think about the world, and we do like to have exposure across that business cycle. In terms of how we find those ideas, you can go on to the next page if you'd like. We really consider ourselves all capitalization managers. So by that, we were looking at small companies, mid-sized companies, large companies. We really want to have our universe be as large as possible so that we can go where the growth is. So in terms of idea generation, it starts with around, basically the entire market of 3,000 domestically traded stocks. We will use, various screens. We'll do financial analysis, finding the companies that we think have the greatest fundamentals. So again, that revenue, cash flow, and earnings growth. And I think that positioning or the ability to look all capitalization gives us great flexibility. If you are a large cap only manager, you may be precluded from investing in opportunities early. And similarly, on the flip side of that, if you are a small cap only manager, you may have not all, but you may have a mandate in which a company grows from $1 billion to $10 billion, and then you are no longer able to own it and are forced to either sell it or move it to a different strategy. So again, that all capitalization structure, I think, grants us a lot of flexibility to look across the view. Once we kind of have, a bucket of ideas, I'd say we consistently have many ideas that we're all discussing, like I said, in that group format. We do, evaluate financial and non-financial elements of those companies. We complete rigorous company due diligence. So we have an internal buy checklist. We evaluate upside and downside valuation potential. We do have an ESG review, so looking to see what companies are leading the pack in terms of disclosure. I will be forthright that disclosure is often best at some of the largest companies. So we do see a challenge at times with smaller companies either not having the resources to disclose or not making it a priority. But we do look at ESG where we can and see where there's opportunities there. And that all kind of boils down to a portfolio of around 30 to 50 stocks. So again, this is more concentrated than a broad market portfolio. And ultimately, our goal is to think of this as a market of stocks. So picking from the best rather than owning the entire spectrum. So we tend to have very high active share in the 70, 80% range. And then weightings in the portfolio are really a reflection of our conviction. So if we have a new idea that we have fully vetted, we've done the due diligence and we have conviction there, we will likely start the position at a 0.5%, maybe a 1% position. Just kind of depends on the breadth of opportunity, but we like to start small. And I think that grants us the ability to dip our toe in, take advantage of an opportunity, but then over time, get to know the management team, really dig our feet in, understand the business, and a company may grow in weight either due to market appreciation or our increased conviction over time. So you'll see that if you were to look at the weightings in our portfolio, they average kind of in that 2 to 3% range. And then the upper quadrant, our top names, those are companies we've owned on average for 7.5 years. So again, companies that may have been, really disruptive and maybe doubted by the broader market years ago and are now established players that are still contributing great growth rates. So obviously, if those companies turn a corner and completely lose all avenues for growth, that would be a source of an exit conversation. But a lot of these companies who have built up the talent and the capital over the years to continue to be innovative, remain in the portfolio today. So the next page, I kind of touched on that all capitalization strategy. I won't go into that further, but in terms of industry exposure, we call ourselves sector agnostic. So again, we will go wherever the growth is, but we're looking for really durable growth. So that has tended over the years to be in the technology sector, at the forefront of innovation, as well as the consumer discretionary sector. I think it's easy to doubt how much power the consumer has. And even in various kinds of consumer spending regimes, there are pockets of growth. And we sometimes find some of our best ideas outside of those fundamental screens, but really looking, what am I spending my money on? What are you all spending your money on? Is it goods and services? Where are my peers, your peers going to work? Which technology firms or other businesses are attracting the best talent? So we tend to, concentrate on those two sectors, but we really have had exposure across the board, and we'll look everywhere we can for some of that growth. And I think, that tends to lead to the question of risk management. So I know I can't get out of here without talking about risk management. It is a definite important part of our process. And I think we like to say that we think about risk in kind of two perspectives. There's the kind of most obvious, what is the likelihood of permanent capital loss? So at times this can be buying a stock and either losing conviction, or maybe we were just wrong, which does happen, or maybe we sell it too early and we lock in that capital loss. That is a risk that tends to be focused on a lot by the public. It is definitely top of mind. But the other avenue of risk management that we really think about is, what's the risk of missed wealth creation opportunity? So how are we, debilitating ourselves by not being willing to get in early or take a chance? So again, that what could go right mentality is something we discuss constantly amongst ourselves of, could we take a 1% position in this and hunker down for a while, as long as we know the fundamentals are still intact. We still believe in the business. I think our fundamental analysis helps support and mitigate some of that risk management. But again, we try to be, the most optimistic, being aware of all the risks, but also being patient. So we are very critical of our management teams. We're critical of these fundamental growth expectations, but we like to, lean back on that what could go right mentality. So that tends to lead to the question of, where are we looking today? I think you've probably heard from other managers here today, even in the last 48 hours, it's been an interesting time in the stock market. I think, we benchmark against an increasingly concentrated benchmark that has its own challenges in terms of relative performance. So really, performance in the last couple years has been driven by some of the largest, most well-capitalized companies that are great companies, and we wouldn't argue against that, but we do see other avenues for growth in other areas. So we welcome, some more market breadth where other companies or people are really focusing on the fundamentals of these other companies rather than being driven just by, macroeconomic estimations or what's going to happen in the election. I know that's a topic of conversation. So we're really looking to invest beyond that 1 to 2 year time period and focus on the long term. So I think AI is an obvious avenue that I'm sure we'll discuss today. It's an area of the market that we actually have been invested in for a long time. If you think about, many companies have been talking about efforts in artificial intelligence and machine learning for much longer than just when ChatGPT was announced, which kind of made it more top of mind for a lot of consumers, at least. And in terms of AI, we call it the 4 stool legs of AI. So the first stool leg, this is page 18 of the confidential presentation. The first stool leg really being the building blocks. So the compute and the memory and the storage, the chips that are going into these technologies, into the data centers. What are the maybe more hardware focused elements of artificial intelligence that are required to build out that kind of infrastructure? So again, companies like NVIDIA, AMD, ARM, companies that we have grown in familiarity with. We've actually owned NVIDIA since I think 2017, initially investing in it as seeing success with their chips in the gaming application. And I think at the time when we did our initial research, AI was, maybe the 3rd or 4th bullet in terms of growth opportunities, and look at how much that business has grown today. So that's, again, the building blocks. I'd say that the second stool we kind of consider are the data vaults. So in order for AI to be successful and impactful, it needs to be trained on a significant amount of data. So what are the companies that either hold a lot of that data or will train their own models on their data? So think of this as, the Amazons, the Metas, the Netflix, where they have really strong customer cohorts for long periods of time. They may look at what you're watching, what you're buying. Not talking about selling that data elsewhere. I'm just saying, they have a lot of data that they can train their own models on and maybe become more efficient and deliver you better suggestions. The third is really, the distributors. So what companies are going to get AI into the hands of the people, whether it's enterprises or consumers? We think of a company that we've owned for a while, ServiceNow, which is basically an IT help desk for enterprises. So they can help companies become more efficient by using AI tools and may have a revenue benefit down the line as well. And I'd say the last stool that we've been talking more recently, and is maybe more longer term to think about, but the beneficiaries. So who will benefit from AI? Likely all of us and every company in some way. That's probably a question that's a little bit further down the line in terms of who can use it most successfully. But we see plenty of opportunities for AI to help improve margin profiles, improve efficiency. And we're really excited about all of these stool legs, and we appreciate the opportunity to have exposure to all of them. But I won't sit here and say this is a pure AI portfolio. Again, we are going for where the growth is. So we see opportunities for growth, like I said, in many consumer companies as well. Digital advertising, e-commerce still remains very underpenetrated, electric vehicles, autonomy. These are all areas of innovation and growth that we've been investing in for a long time. So I will kind of stop there and see if there are any questions, unless there's anything Tom wanted to add. But again, just reiterating, this is a concentrated portfolio of growth positions, and our focus is truly on the long term, what could go right.
Okay. Yes.
Trustee.
You are my woman-owned firm. I don't see a diversity profile in your packet. Am I missing it, or did you
No.
mention that? May when I,
We did, they're on page 4 of both the public and the confidential handout. We have a statement on diversity in EEOC. Up until 3 years ago, we had completed the broader study. Upon some review of employment laws and privacy laws in Washington and outside counsel, and being only a 24-person firm, we were advised for employee protection, employee privacy, and to comply with some of the equal opportunity employee laws that we should not release as much information. So what we've tried to do here at the table for you and the statement is give you an outline of what ZCI is all about. I mean, those of you that have been here or have worked with us for years know Nancy, our president and sole director, is female and owns 65% of the company, as Danny mentioned. Our executive team is 75% either female or minority identified. Of the 24 individuals as part of our firm at the end of 2023, 42% of the firm is female. 19% is either affiliated with a different race or ethnic category. Nancy has prided herself since she founded Zevenbergen to really identify the best talent and support all different ethnic backgrounds, sexual orientation, sexual identity, and disability status, and feels that anybody that got to know Zevenbergen and work with them as long as they have will see that we are a very diverse for a very small institution, and continue to focus that way.
so why not put it in writing like everybody else does? Fernando, can you speak on that, please? I didn't realize there were exceptions to the rules to not provide, because, break down female, male, and then their positions. That's another thing.
I mean, we did request that information, and this is what they returned with most recently. So
Recently, so they were doing it at one time?
I think at one point, yes.
You think or you know?
According to him, I don't have the whole history. I only go back 2 years, but
But there's history prior to that, if they've been around since early 90s.
Let me interrupt here. It sounds like what I'm hearing though from them is that their legal counsel told them about 4 years ago to change what they were putting in the package.
That I heard, but I just want to know, I want to make sure, is that it, and Fernando, if that's, are we in compliance? And that's their attorney, but then we have our attorneys. We have a large legal team here.
Right.
So I don't know, I'm asking. The other thing I noticed is on all your sheets, you say confidential, and just so you know, everything that you've given us is up on the screen there. So it's no longer confidential. Anybody who's attending our meetings, where it's virtual or not.
That's okay.
That's fine. We provided 2 presentations, a public copy and a confidential copy.
Pardon?
I'm sorry.
Could you talk a little bit slower? You're kind of.
We provided 2 copies of our presentation, a public copy and a confidential copy, when we sent the
Okay,
material into
right.
so
So
when we
which
were-
one, so which one is on the screen though? I thought it was the same thing that we have.
They are largely the same. The confidential piece you have up here, it just has a few more required pages that you all requested,
Right.
but they are essentially the same.
Yeah, that's what I thought. Fernando, what is your?
so I just checked with staff, and they've said that it's been longstanding practice that they have not provided this information in that table format.
Okay, well, we can talk about that
Yeah,
later.
that would be a discussion without them, and if that's something.
Well, yeah, no, that may be theirs, but we're the trustees and, it's everybody, I mean, a lot of people want to keep it confidential. I don't know. Whatever their attorney says, I understand it.
Yeah.
But everybody else, and that's fine, but that's your attorney, not our attorneys. And everybody else that we requested has always provided this information. So
Very,
it's an interesting topic that we need to discuss. Thank you.
very much acknowledge the request. Like I said, outside legal counsel. I would argue a little bit is sitting in the lobby or sitting in every other conference I attend, I at least bring a little bit of diversity. I think our team as a whole, like I said, is very diverse of background, of thought, of gender. And I think it is a sensitive subject. Absolutely. I think as a small firm, we do our best to look everywhere for the greatest opportunities.
And I understand, as you say, you do your best. That's what you're saying. I'm listening. But everybody's interpretation, this is the best I can do, or this is as good as I can do. So if you're doing that, I just couldn't understand why it would not be in writing. I mean, I'll stop there. Thank you.
Right, thank you.
Thank you.
Yes.
Trustee Washington.
Good morning.
Morning.
Thank you for your presentation. I will say that I do agree with Trustee Rodriguez from the perspective of, and if it's not even in a public package, I do understand that, but I would like to know what those diversity numbers and things like that, what that actually looks like. Because it is a part of our policy, the way that we invest and things like that. And so I get it from you all's legal perspective, representation, maybe publicly that could be problematic, but considering that we are sharing a business space with you all, and that's part of our requirements, I do think that it would be wise to, if you all figure out how to do that.
That's a very fair point, and we will take that back to Nancy and the team, and definitely we can discuss that further with staff.
Thank you.
Thank you.
Thank you. Any other questions?
Thank you.
Okay, yes, go ahead.
Because I noticed the AI opportunities, and it seems like you guys may have got in early with some AI investments. My question is, how do you use AI, I guess, in terms of, internally, how do you use it?
Yeah, it's a great question. I don't think that we are at a point as a society, or at least as a firm, where we fully entrust AI to do our jobs for us. We do think human intervention, especially in investments, has a place, and we continue to believe that the art part of investing is very much still a people business. So, within our IT department, I know they've looked at various AI opportunities in terms of getting efficiency around, cybersecurity, pulling data. I think we, use various technology platforms, whether it's in the operations of our business or in understanding company financials and fundamentals, where there are, AI tools in some of those research processes. So we are Bloomberg and FactSet users. Those are the technology platforms we use. They have their own AI tools. But in terms of decision-making, that is still and will always remain a human-based, team-based element.
I could just add, Trustee, on the operations side, we have, Danny mentioned it, data side, we have developed or in the early stages of using the technology a bit to try to help us sort data within our own company. So when we're answering questionnaires, putting material together for presentations, getting historical data or historical, we've created some tools that pull that for us as we've saved it all in one location, is able to source it for us and help us see the most recent, the most up-to-date, historically what we've done to help make our jobs a little bit more efficient when we're responding externally to clients or to prospects or to consultants and that way around. So it's early stages, and we've used it in some phases, and there definitely is some work to be done. But it's I think like a lot of firms, as Danny mentioned, it is definitely trying to make sure you find some benefit, but not rely on it 100% until you're sure that it's doing what you want it to be doing.
Mm-hmm. Okay, Trustee, let's show.
Well, just comment real quick. Yeah, it's probably wise to integrate it carefully. But I was curious, and just mentioned that the update that affected the airlines so badly a few weeks ago, and I'm just curious how you guys move to try to see how that impacts things and how that played out for you.
Yeah, absolutely. So what you're referencing is the CrowdStrike and Microsoft error that occurred that it was a cybersecurity issue. We are owners of CrowdStrike, so we did definitely feel that correction in the market in terms of that company. It is not the first cybersecurity company who has dealt with an issue similarly. I think we were happy to see CEO and founder George Kurtz immediately get on television and talk about exactly what happened. We haven't always seen that from security providers who have had breaches in the past. So I think it's probably too early to say how it's going to impact the company financially. I'm sure, in some element it will impact maybe like renewal discussions. We are already seeing across software, across technology, discussions from or sales cycles taking a long time in the broader industry as a whole. So I'm sure CrowdStrike will feel that. But we do still believe the company is the leader in its space. So endpoint security, securing devices, they still have a very strong hold there. And compared to competitors in the space who are maybe lack profitability or are earlier in their stages, I can't imagine that they I'm sure they were happy, unfortunately, to see a breach of some kind, but I don't necessarily think it ruins the opportunity set for CrowdStrike. So it's something we're continuing to monitor. Of course, it is significant, but that's how we're thinking about it.
All right. Thank you so much. I think we have reached that time limit. Thank you for being here and you have a great day, great presentation.
Thank you for
Thank you so
having us.
much.
Would it be possible to take a 3-minute
Yeah,
break?
That's what I was just gonna say.
Oh, good.
Can we take, before
Please.
bringing in the next, can we have like about 5 minutes for a biological break? Thank you.
Thank you. Break.
It's a small cap domestic equity growth manager with 125 million of our assets. This is a more recent relationship dating back to 2018.
Oh, okay. Good morning.
Morning, everyone.
Good morning, Conestoga, and welcome to Chicago Teachers First Friday. With us today from left to right, we have Trustee Vinson, Trustee Washington, Executive Director Lenore, Trustee Blackwell, Trustee Price Ward, Trustee Ochoa, Trustee Beza, Trustee Rodriguez, and joining remotely, Trustee Riley. Our Chief Investment Officer, Fernando Vincents, our consultant from Callan, Tony Lasuzo, along with investment staff. You'll have 25 minutes to present, followed by 5 minutes for questions, and you may begin your presentation now.
Good.
Thank you.
Welcome.
I'll start off just with an introduction. My name is Mark Cluin. I'm one of the managing partners at Conestoga and our firm's president. And with me today is Joe Monahan, who's a co-portfolio manager and also a managing partner at Conestoga and has co-managed the CTPF portfolio since its inception back in 2018. As Fernando mentioned, we're one of the newer managers on a relative basis to some of your others, coming on in 2018 with an initial funding of about 40 million. We had an additional placement in 2021, bringing assets to roughly the $125 million level that he mentioned. Our firm's total assets at the end of June were just under 8 billion. Roughly 6 billion of that is in the small cap growth strategy that we manage for CTPF. And that strategy, I should say, is one that we put into a soft close. We're no longer taking new client assets into the small cap growth strategy. We're just taking additional flows from existing clients. CTPF was actually one of the last significant fundings that came into the strategy back in 2018. I think you'll see that our long-term results are consistent with our objectives for your plan. Shorter-term results have been a bit more challenged, and Joe will speak to that when he speaks to the performance in your portfolio. I'll just briefly mention on the brokerage side, we have a target of about 35%, or I shouldn't say about, of 35% for MWDB brokerage. Last year, we were a bit over that, not quite 40%. Year to date, we're doing a little bit better. Year to date through June, we're actually up at just over 50% on the MWDB brokerage. Moving to the EEOC tables, you can see on page 3 of our public presentation or page 5 of the confidential. At the end of the year, we were a firm of 16 people. That was 11 men and 5 women. One of the men is Asian. We did not make any hires in 2023. We did make a couple of hires in 2022, 1 male and 1 female. And I can say that in 2024, we've made 2 hires, both males, one of whom would be a diverse hire, an Asian male. And I guess I would say, touching on the EEOC tables, one of the things I'd say is that our presentation in 2018 and maybe events in the world since then. But I would say the comments from CTPF when we took on that funding and in our conversations with former staff and current staff, I think the message that we would have back to the board would be thank you for helping us to think about this issue as we go through our hiring process. I think as a small firm that was founded back in 2001 with 8 people, we probably didn't have as sophisticated a hiring process as we should for the modern era that we all live in today. And so we've really thought about our hiring process since 2018. And I think we've done a nice job of building out a more diverse pool of candidates. And I think that would be reflected in the 5 hires that we've made since CTPF retained Conestoga in 2018. We've had a much, much, much larger pool of candidates and a much more diverse pool of candidates. So I think that's really been a positive impact on Conestoga. And CTPF deserves some credit for pushing us in that direction. I would also say we've done some things to try to outreach in our community. About 4 years ago, we partnered with a Philadelphia school that works in an under-resourced community in a work-study program where we have 2 students through the school year, each of whom would come out to our office for 1 day per week and are resident with us to give them an insight into our industry. So we just completed our 3rd year of that, and that's been a really positive experience for us. And we like to think for the students that have gone through that program as well. And it's one that will be continuing into the future. If you turn to page, let's say page 6, I should say let's do page 6 of the public presentation. You can see some highlights on Conestoga. I've mentioned firm was founded in 2001. We've grown our assets nicely to where we are today at roughly $8 billion. We've remained 100% employee owned. As we sit here today, 14 of the 18 members of the firm are owners of the firm, and that's something that is a point of pride for us in our firm's culture, that culture of ownership. We've had stability of our team. Joe and Bob Mitchell have been co-portfolio managers working together on this strategy since 2008. And we believe our investment team has a very deep experience and breadth of experience. Page 7 is our people. On the left-hand side is our investment team. And I'll just point out those more recent hires. Jaisal Kadawala just joined us as a junior research analyst. The other new hire this year is on the far right, Neil Walker. The other hires that I would mention that happened since CTPF retained us in 2018 in the lower right-hand corner, Bronwyn Dewey, who worked with me in new business development and client servicing. Christina Kowalski, who is our head trader and just became a partner last year, and Ted Chang, who's a co-portfolio manager on our mid-cap strategy. So with that, I'll conclude my comments on the firm unless there's any questions now, or I'll turn it over to Joe to speak a little bit about your portfolio.
Great, thanks,
No,
Mark.
we will hold questions until the end.
Okay, thank you.
Maybe just a refresher on our philosophy. I think I'll spend a few minutes there, give you a kind of a higher view of it. I'm happy to dig deeper if you like, but certainly we are best described as a high quality, conservative, small cap growth strategy. We take a long-term view of analyzing companies through our due diligence process and really are focused on finding companies that can deliver growth in a more consistent, predictable, and sustainable manner over our time horizon, which is typically 3 to 5 years, and in some cases longer. We'll hold stocks longer than 5 years if they continue to execute on their plan and meet the growth objectives that we think they should be reaching. That type of business, coupled with companies with strong balance sheets that can deliver strong cash flow, has really it creates a strategy that I would call a lower risk, lower volatility approach to small cap investing. And that really manifests itself in our downside capture, which I'll highlight in a few minutes. That's what we pride ourselves on. I think most of our clients, probably what they appreciate most about our strategy is that downside protection that we've exhibited historically for Chicago teachers and obviously other accounts. For us, quality is really made up of qualitative and quantitative aspects. Quantitative elements of the strategy certainly are companies with high return on equity, high return on invested capital, strong growth rates, strong balance sheets. That's all measurable. From a qualitative standpoint, and a lot of the due diligence obviously focuses on this, is assessment of the management teams, the competitive landscape, talking to customers. All those elements go into the decision whether this is a company that we believe belongs in our client's portfolio. And that process can take 2, 3, 4 months in some cases. We're a low turnover shop. We own 45 to 50 stocks. We're adding 6 to 10 names per year. So we can take our time and really understand the business and determine whether it fits what we're looking for in a company. The 45 to 50 stocks, we believe is ample diversification, but doesn't dilute our efforts to add alpha, excess return for our clients as well. We think when we get beyond that, you start diluting yourselves a bit. We think that's the correct number as far as number of names in the portfolio. So first and foremost, coming up, identifying high quality businesses with those strong fundamentals, and then also valuation is an important component as well, as you can imagine. We look for companies that can grow earnings and cash flow in a 15 to 20% range. And the way we look at valuation is if we believe if we pay a fair value up front and it holds that value through our investment horizon, that earnings and the cash flow growth is what's going to dictate the returns of that stock. Meaning, if it's a 15% grower, we pay a fair price up front, that could have the potential to double over a 5-year period. If it's more of a closer to 20% grower, that could double over a 3-year horizon. But that's the essence of the valuation component of our process. Just turning on the public presentation, page 9, just highlighting and quantifying that downside protection I mentioned earlier. You can see on the left side in down quarters, in up quarters, we usually generate about an upside capture of, call it 85 to 90% is within our historic range. Obviously, you get fluctuations around that, but that's kind of our average and our expectation. But really, I think we add our value in the downdrafts, the weak quarters, the weak periods like we've seen even in the last couple of days. There, our downside capture historically has been in that 70%, 75% range. That's what we expect of ourselves. And that's really the goal. And that's really the driver, even though it's the weaker markets that were outperforming, hanging there in the tough markets. When you combine those two, you can see our long-term track record is very solid based on that downside capture. Maybe just the next few pages are just a little more in-depth look at the process and philosophy. Happy to address those if anybody would like to. But I think flipping to the performance page would be useful. Mark mentioned our long-term numbers we're pleased with, but certainly the short term has been challenged for us. The year to date thus far this year has been certainly underperformance, and we're never happy with that. I mean, we're coming out of 2023. It was a solid year for us. We were up about 22% versus around 19 or so for the index. So pleased with that. But this has been a challenging period. Each quarter this year has been a little bit different. Q1 was really driven by what we don't own. I don't know if you've heard the names MicroStrategy and Supermicro, but they're two stocks that were in the index that within the benchmarks that we couldn't own because they were too large. The total underperformance in Q1 was because of those two stocks up significantly in the first quarter. Second quarter is on us. We had weak stock selection, and certainly I can dig in further that, but weak stock selection in several sectors, most significantly in healthcare, was the weakest component of the portfolio. Consumer discretionary and telecom was also weak for us during the first quarter, or excuse me, the second quarter, and that was the driver of the underperformance for the period. Just flipping ahead a couple pages to page 18 with the sectors. This is pretty typical. You can see where our overweights are in healthcare, industrials, and technology. This chart would not look a lot different if you looked at it when you joined us 10 years ago, 15 years ago. It's not that we target sectors per se, and we never exclude sectors. The portfolio is built from the bottoms up, and the type of businesses that I've described, we tend to find them more regularly in these areas. Industrial, just to give you a little more insight there, industrial sounds very like that's cyclical type businesses. For us, that leans towards like business service type companies that do fit our criteria. Healthcare tends to be medical devices and companies with disposable, consumable elements of their revenue, as opposed to biotech, which have a binary nature to their business. It's either a hit or miss. A drug gets approved, it skyrockets. If not, it gets hit hard. That's not that's not part of our investment philosophy. Technology, we tend to be higher weighted in software. Those companies tend to be have more of a recurring revenue nature to their revenue stream, as opposed to maybe a semiconductor that is more cyclical, capital intensive. To grow, they need to expand their fabs or build new ones. So we're more attracted from our philosophy standpoint on software type businesses. Cash, you can see at the end of the quarter was 3.8. We typically, we're always under 5%. It's probably more typically in the 2 to 3% range, but that's just a residual of activity that's going on. We don't target cash other than to keep fully invested under 5%. So if we have a couple of trims, maybe at the end of the quarter, maybe that ticks up a little bit. If we had a couple of ads, it might tick down, but certainly within our historic range of cash level in the portfolio. And then finally, the page 19, just the characteristics of the portfolio, just to reinforce the high quality nature of the strategy. I would focus you from a price earning standpoint on the second line. That includes negatives. Our companies looking out the next 12 months are all profitable, but about 20% of the index is unprofitable. So to exclude those, which the first line does, we don't think is accurate. So the second line, you can see we're as of June 30th, a little bit of a premium to the index, which is not unusual. We certainly sell at a premium historically, given the higher quality nature of the portfolio. And then the earnings growth based on these estimates, 16%, which is certainly in the range. As I mentioned earlier, we have companies that can grow about 15% through a market cycle. So clearly within that range, the index is expected to be a little bit faster growth, but I would say our growth is more predictable and consistent versus the index, which can be more volatile. The weighted average market cap, you can see we're a little bit below the index. At the end of the quarter, return on equity, double the index, and then the stronger balance sheets is reflected in long-term debt to capital. Maybe it's just worth for every mention, June 30th, the rebalance of the index had not occurred yet. It occurred on the close of the 28th. So as of July 1st, the index did change a bit. The PE actually went up pretty dramatically from 29.7 to 35.7, so a big jump there. So we're now at a discount. The growth rate that came down to 16.7. The market cap did fall dramatically, and that's because Super Micro and MicroStrategy left the index. That fell to 3.6 billion, so significant drop based on those two primarily leaving the index. The ROE dropped sharply for the index to 1.7, so we're now more than 4 times the index as far as quality of return on equity for the portfolio, and then the debt stayed about the same. My last comment will be just the top 10. We're typically in, I would say, the 35% range. It's a bit above that. I think that's an indication of the conviction we have in the current portfolio, given that we've underperformed a little bit here. Some of them, nothing huge, but we've let some of the, or taken some of the higher weighted top 10 stocks a little bit higher than we normally would based on our conviction and evaluation in those names. So let me stop there and certainly address any questions that you have.
Do you have any questions?
You're saying you're still 1% or you're percent? No, that's all. That's
okay. So
sorry.
Yes, go ahead, Trustee Ocho.
So, yeah, so historically, you guys have performed well. Like a lot of managers, the 22 was a tough year. So is there something that you're tinkering, adjusting just to be able to withstand these strange changes in the market, or is it?
The simple answer to your question is no. We are not changing our philosophy. It's worked very well for us historically. The type of businesses that we own in the portfolio have shown the ability to outperform over a longer time period. Yes, we will underperform in certain quarters, certain years. That's unavoidable in this business for sure. Our focus in those periods is when we have a stock or stocks that are giving us issues, our focus is, has anything changed in our long-term thesis of this business? Often it's short-term issues that are driving underperformance, and that has happened in several companies in the portfolio this year. Our job is to determine, is that changing the fundamental outlook for that business over the next 3 to 5 years? And if the answer is no, you're going to see us certainly continue to own that stock and in a lot of cases add to that stock. We tend to underperform in those very strong, robust risk-on markets. I mean, I know it's short term and we don't focus on the short term, but I think we've gotten over the last 2 days where the volatility of the market by certain measures, the VIX index has shot up. Risk has become kind of a little bit of a risk off. We've delivered our 70% downside capture yesterday and today. I know it's 2 days and just as an example. So we think the portfolio, while it underperformed in the short term, and we certainly have sells and we had a number of sells this year based on fundamental deterioration from the long-term perspective. We believe that is one of our main jobs as analysts to determine, is this stock still competitively well positioned, that they can take advantage, capitalize on the opportunities, the growth opportunities they see in front of them, and then weight it appropriately in the portfolio.
So if I understand you, so we just look at a longer stretch of time that your approach works out, no need to change, because that's an exception. And if you look at 10 to 15 years, what you've been doing works out the best.
That's a good summary.
Okay.
I'm not saying we don't learn along the way. There's certain lessons you're always learning in this business. An example of that is it's going back a little ways now, 5 years ago. We had some energy stocks in the portfolio that we thought had competitive positioning regardless of the commodity price. What we learned was commodity price trumps competitive position in those commodity industries like energy dictated by oil prices, natural gas prices. And even though they had competitive products that we believe would take share, those companies still got beat up bad. So we kind of readjusted our priorities, so to speak, a little bit on industry conditions. We don't invest in commodity businesses, and we didn't invest in those energy companies simply to get energy exposure. We thought they had real competitive advantages, but that didn't hold up, so to speak, in a weak commodity environment.
Okay.
So we're always learning. I'm not saying things are static, but the essence of our process philosophy has worked well, and we don't see a need to change that in any drastic manner for sure.
Okay. Thank you.
Yeah.
Yes, Executive Director Lenore.
Yeah, thank you, Mark and Joe, for your presentation. Can you talk about, since you're a smaller firm, how you use succession planning to manage the risk of being a smaller firm?
Sure. You would take that one.
Yeah, I think one of the things we've done over time is really just building out the team and then sort of have a range of ages in terms of people, right? And so we sometimes get that question now, what would happen if this person retired or that person retired? And I would tell you, we feel very good that the replacement for anyone that departed our firm is on that org chart right now. And so it is something that we think about, myself, Joe, Wayne, and Bob, the 4 managing partners. That is something we think about. And then I guess I'd say, maybe more on the pure risk side, we do have key man insurance in place so that if, something really unexpected happens to someone and we are in a situation where we need to fund the buyout of their ownership in the firm, we have key man insurance to assist us with that.
Okay, seeing no more questions. Thank you for coming and presenting and answering questions. So we reached our time, so thank you.
Thanks very much, everyone. It's good to see you all.
Okay.
Appreciate it.
Yes. Yeah, make sure. Okay.
Okay,
Thank
I
you.
guess so we'll do a quick wrap up. I'll turn it over to Tony to kind of do a little summary.
Yeah. So just briefly, I think the managers are what we wanted to hear today. Nice selection of managers from those that are, yes, definitely. Thank you. Heard from a variety of managers today, much like the last time, where I think it's interesting. We had managers that are performing well, that are not performing well. We had fixed income. We had some equity, US, equity global. I think the thing that binds them all is they all are relatively active and have a certain degree of movement around their benchmark. And we see that during years where they overperform and underperform. And I think that's one thing that I always like to think of is look at the long term, figure out where they're underperforming and where they're overperforming. If they're doing very well today, they may be taking bets in that. And what I heard from the managers today is they're sticking to their knitting. Which is always a good thing to, no one's panicking, although we'll see what happens. The market's pretty ugly today.
Excuse me, are they still out there? The door's still open?
No, I think they've left.
Okay,
Yes.
okay, thank you.
This is public enough anyway. I mean, there's no specific things. We do have two that are on the watch list. I don't think there are any changes with that today we'll obviously discuss with staff and see where things are going. But I'll open for questions. Everyone has been generous with their time and listening and asking some good questions today.
So Tony, with this demographic, employment demographics with Zeffenberg,
Yeah.
I'm just a little puzzled as to how do we measure your demographics based on our policies? And DEI, we're DEI focused, all of that.
So I think what I took from that conversation is we're going to work on that a little bit, and we're going to see if we can get them to disclose information to us that would be confidential just for our purposes only. So we will work with them on that. Because I agree, there should be a way for us to get the information we need. And I mean us as in Chicago Teachers Pension Fund. So it's not unusual for people to have, they'll get comfort with it with their legal counsel, but it may take a little while. And I think it's something we can address. So hearing that conversation today, Fernando and I will work on it. That's for sure.
Yeah.
We're not taking that as we're done.
No. But we don't know who's in what position.
Clearly.
We're looking at upper management level.
Yep.
And then this is a female-owned company.
Yep.
Then we have a gentleman sitting here.
True.
Okay, so I have, wonderings.
Yep.
Yes.
Yeah, and if
go ahead.
if there's an exception for one, then everybody can say and go to an attorney.
Agree.
And,
Yes.
and if there's, I would think, and I say, it's sincere, I don't think they probably have anything to hide, but I don't know. And I need to see it because we make decisions or we give people more money. And then, in the end, what they will say, well, the trustees voted on it.
Yeah.
It's not.
So
And then my second part of my question was, I like the way Blair did that summary, and there was one other firm that did the summary as well. Can we get them all to do the same? It's like at a glance, remember those planners years ago, they used to have, boom, boom, you've got everything there instead of flipping through pages, because everything else is fluff. It's just showcasing, that's it. But when you've got that, you have a better idea, and we can focus on our questions based on those summaries.
I do like especially the William Blair summary. I thought that was really nice.
Because you heard me say it, so you.
Yeah, no, but
I'm joking.
but
No,
after
no,
you
but-
after you highlighted it, I
No, I
turned to
do,
it and
I do.
boy.
I think they did a great job.
So I think
That
that's
was-
something.
We can ask that from our incumbent managers. I don't know if we'll have the same kind of information from prospective managers.
Oh, yeah,
because-
but
so then the question for you is this helpful? So, if we do this twice a year, every 6 months, we bring in maybe managers that are struggling to kind of better explain to you what they're doing. Is that helpful? Because We can't bring in everyone, right? But we can certainly pick a handful and we can do it twice a year and we can carve out
We
time.
used to do it on a
Yes,
regular
I-
Right.
basis.
Yeah,
It's just-
I agree.
All
and I-
day,
Right.
all day.
That's, I mean, again, it exhausts, it's exhaustive, I should say. So I'm trying to find a middle ground where we can do.
But if you time it the way it's supposed to be, because we're over, I mean, there has to be more structure. There really has.
Let me see.
And it
Excuse me.
can be done. We did
Excuse
it
me,
for
Maria.
years.
Mayor Sharon?
Yeah, I
Did
mean,
you
we
have-
always used to have that summary at the beginning for everybody. And it
We
made
don't
it
now.
easier to look at.
Yeah.
Yeah, I mean, it's at a glance, it's a
Mhm.
Right,
snapshot,
exactly.
which is helpful because we're looking and then there's this conversation about the private and the open for the meeting. What are we doing? What are we showing on the screen?
Yeah.
Are we doing the, just the public?
Yeah.
And this is us with private.
Mhm.
So we have a little more, and I like that they do have the pages, that they have the private page number and the public page number.
Yeah.
So if that can be delineated a little bit more,
Yeah.
a little bit more, and
Yeah.
just, and
And it's
just not a lot of, in the presentation, you're here for due diligence. Tell us what's the problem and how you're gonna fix it. That's all we need to know. What is the problem? How are we gonna fix it? Tell us the numbers. We could see the numbers right here, but using the numbers with those simple explanations, we don't need we don't need to kill all these trees. We need to make sure that, less is more. But if it's something very serious where you need to, if we're in serious shape, if we're in a position where we have to look at terminating, yeah, we want to know. We want to give everybody a fair chance and an opportunity. But it boils down to what's best for this fund.
I think one thing we could do, briefly.
Go ahead.
One thing
No,
we
no,
could
go
do is to, and coaching's the wrong word because I don't want to coach a manager to tell you guys what to say, but coach them on what we need to have answers to.
Yes.
So, and I think we can work with managers. And as we start to do this more frequently, if we are going to do it, it sounds like it's helpful.
Yes, it is.
We'll make sure to add that summary up front and what are the topics that are important to this Board of Trustees.
Exactly.
We do actually provide them an outline of what we're looking for. I think that's why the EEOC chart and the table, but I don't know. We'll actually tighten it up so that when they come in, you have this format in such a way that, it's consistent.
Cho is next.
Oh, yeah, that's fine. No, I didn't know if you.
Oh, I see you. Yes,
Oh, I
got
didn't
you.
know you didn't acknowledge.
No, I
me.
saw you. I saw you.
Yes, I mean, well, just comments, was just being addressed. Just if they're going to say that they do a good job, just the words aren't necessary if we could just see it right there on paper.
Right.
But also that you have an outline. I mean, I could see things being on there like willingness to have unions and, what they do. And so there's a bunch of factors. And I know the majority is going to be like, no, but sometimes it's not.
Mhm.
And again, these kind of issues are secondary. I know we got to make the fund as much money as possible, but the factors are important when and if they can be used as a measurement. I think looking at it, getting the standard information will be useful. To what was asked though about doing this every once in a while, will it become at some cost is I guess what I'm wondering. Will we still be able to do the first Fridays with
Yes.
those presentations? Will it cut off some of that or can we do both?
So we technically have 6 First Friday meetings for the year. If we carved out 2, that leaves 4. And the other thing is, I think in the past, we've carved out at least twice a year for real estate. So then that leaves 2 for everything else. We can claw that back so that maybe it's just 1 meeting for maybe watch list or underperforming managers, and then maybe one for real estate, and then that leaves 4 for everything else, more thematic. That's open for discussion as well.
Trustee Washington.
Okay, so to that point, real estate is, I mean, we have some real estate investment already, but then that's another area that we're also looking to invest in more. So in my opinion, I don't want to claw that back personally, because we're really trying to figure out how do we go into that space in the most efficient way that's going to generate the most income for us. I mean, because we still got to pay benefits. And the flip side of that is I do want to hear from the people on the watch list, but to Trustee Rodriguez's point, like the summary sheet, that I think is helpful. Hearing their perspective is helpful, but at the end of the day, I'd rather take a first Friday that is like we do like half day and then we have something else scheduled. I'd rather just have that one day just for that. Let's stretch out, have lunch, and then come back and hear the other people.
Sure.
But still have the other days or the other allotments for the other things that we're doing. Because I kind of have an issue with having to cut what our priority set is to, I don't want to say, let me watch my words. I don't want us to cut what we need to do, what we have scheduled to do, because we're checking up on, which is our job, don't get me wrong, but if they are underperforming, then they need to kind of step up their paperwork and things like that to make sure that we're satisfied with what we're seeing, so that we're not changing our agenda of things that we need to do to kind of call them in on what they're not doing.
Understood.
You know what I'm saying? I don't think we need to do that, but also that thing with the EEOC and all that stuff, everybody needs to be presenting that at all times. I don't want to hear about what your lawyer told you to do, if I'm just being candidly, transparently honest. And that's no shade or disrespect to any attorney in the room or whatever, but to me, that's evasive. And because you are a publicly traded company, which means that this information should be available. And so if it's not on your website, that's not targeting anybody, because we're not asking anybody anything. I don't want nobody's social security number. I don't want to know your birthday. I don't know who your mama is. I want to know how many people you got working in this establishment. What is your demographic breakdown? Who is your C-suite? Who are the people making the real decisions? Or is this a cat and pony show? Because certain things for me start to feel like a cat and pony show, and that makes me very uncomfortable, because we are the ones that's putting money into these things based on the information that they are providing. But not providing certain information still impacts that. So I just want us to be very thoughtful about that, because that kind of I put a pin in that.
Okay.
So thank you, Quentin, because Fernando and I talked about this previously, and I said we need to do more due diligence. I like your idea of let's have a whole day. Let's move committee to another day, because some of the committees, the information that is it's not a long meeting. It's not a long meeting. I wouldn't be opposed to if we do a committee meetings, if it gets up to 3 meetings. But I like the idea of all day, which is right on point with what we were talking about, due diligence, because we are seeing managers, but I think that we need to be exposed to this due diligence process. When back when I first got on in 2018, there were managers coming in and doing due diligence. But I think that it helps them as well as it helps us, because if they know they're going to be called on the carpet, that's automatically like, get yourself together. Get pull it together, because you are going to be board facing, and we are going to be unapologetic about anything that doesn't sit right with us. And we are sticking with our policy. So thank you for adding that. So let's look at it that way, where we can have like a full day.
Trustee Rodriguez was.
Then I'll come back to you. I know you've talked, so I'm going to the people who have not spoken. Thank you. Yes.
So internally, what precedes a decision to put a manager on watch list because of personnel change. Because their response to the first one, to, the watch list, because of that, it's like there are team decisions. It's like not one person is, solely responsible. So how is that? How do we is it a weighted decision if we put them on watch because of that?
I'll let Cal speak to that. We have our, it'll depend on the size of the organization. If it's, again, a 24-person team and every person is, very crucial, but in a much larger organization where they've got a deep bench and maybe they have, let's say, 3 or 4 portfolio managers and it's maybe an equal committee and they lose one, the other 2 or 3 can pick up. That's a different story, but I'll let Callan chime in.
Unfortunately, it is a little qualitative. So, you have to make a decision. Is this someone who's impacting the decisions of the portfolio? So we try to do that. The key is to do that up front, understanding who the real decision makers are, because then when that changes, it changes. And then you also have the serial changes where that can be a negative too.
Yes.
You have a loss and then all of a sudden another loss. That's an indication of the business that, that could be, they're not doing their business right if they're continuing to lose people. So that's, I think, one of the situations here is we've seen they're changing their business a little bit and they've lost some people because of that. So our job is to understand they're on watch because it's impacting their business. The question is, will they be able to overcome any sort of deficit of the people they've lost? So that's why they're put on watch. They're put on watch when this is going to impact how the decisions are being made at the portfolio level. I wish I had it has to be the PM or the junior PM or someone with a certain number of years. It's much more qualitative and it's based on our knowledge of the managers and how they put their portfolio together. But there's not too many cases where it's on the margin. When someone's leaving who's a senior person it, at least from our point of view when we're reviewing these managers on a quarterly basis.
Well, the other thing also is beyond just portfolio managers, we'll track if there's severe turnover in their analyst ranks. That really tells us a lot about how they're managing people, and eventually, if they can't keep people, that'll impact eventually the portfolio. So.
Absolutely. We have one last question.
Yeah, and it's real simple. Sometimes people come in and they're new and they reinvent the wheel. All you have to do, we have those minutes, download it back to 1895. Look to see what were the agendas of investment committee before, so you could see what happened and what worked. And it's also crucial, starting on time. Number 2, we're giving them more time. When somebody comes in with a 53-page presentation, that's just filling up, trying to, fill up that time. I believe we used to give them, it was either 10 or 15 minutes. Yeah, I know, but I got called present and then 5 minutes for questions.
Yeah.
30 minutes is long.
Yeah, that was the other suggestion. We don't necessarily have to make it a full day. We could split the time so that, we saw 4 managers today. If we gave them 15 minutes, you could technically see up to
We're saying
6 to 8 managers.
6 to 8 minutes, you're right. Yeah, that's another, that's a great.
We're getting 30 when the timer would say 30.
So it is, our next
I know,
meeting starts at
well, we
1.
started late.
And, we didn't have a quorum, and I
No,
went
but you were
forward
gonna,
without a
but you were
quorum.
gonna start with.
So,
I know.
we're not gonna talk about that.
Yeah, okay. all right.
Okay, because we don't need to talk about the obvious. But here's what I'm saying. Thank you for and being responsive. And we can make these changes because we always looking to be better, more efficient, and have the most information. Whether and not, just, we know we hired you. Okay, so we hired you for a reason. So we don't have to go through all of that and say how wonderful you are. And I'm sorry, I made, we're not doing that well. I want to know what you're doing right now. Real time. Okay. So it is lunchtime. So we have to, Yes, and it's one, almost, it's going on 1 o'clock. So anyway, we have to stop.
Yeah.
Oh, yes, make the vote. Okay, it's been moved to second roll call to adjourn this meeting.
Trustee Beza,
Yes.
trustee Blackwell. Yes. Trustee Ochoa,
Yes.
trustee Price Ward,
Yes.
trustee Riley.
I don't see her on.
Okay, trustee Rodriguez,
Yes.
trustee Benson,
Yes.
and trustee Washington.
Yes.
So did I call trustee Rodriguez?
7-0, yeah, Riley's nice.
Did I call Rodriguez? Did I call trustee?
Here, I can't hear you. You called Rodriguez. Rodriguez, trustee Rodriguez, were you called for the adjournment?
Did I what?
Did you vote?
I said,
Yeah, I thought so. Okay.
adjourn.
Yeah.
Thank you.
So are we starting at 1 or?
There you go. There you go.